News, really. Will that mean getting back to normal in that particular sector? DSV also in focus, a big share sale. They're buying part of Deutsche Bahn, as we know, Guy.
Let's talk about it. Let's talk about the session we're about to get. Here we go. It is time for the opening trade drum roll. Not sure the drum roll's that loud this Friday morning. We are expecting a cautious get-go of trade here in Europe. We're expecting really not much action. There's too many things potentially happening over the weekend, and also that big US data print a little bit later on, to allow people to make big directional trades this morning, so you're not getting much direction. There you go. Stock 600 is up by a staggering 0.07%. The FTSE 100 actually looking a little bit more negative, down by 0.3%, but it had a very good day yesterday on the back of what we saw with the commodities story. That may be fading out of the market a little bit. The IBEX may be a little bit more representative, down 0.1%. The CAC's down by 0.2%. The DAX is down by 0.2%. These are exciting markets, Anna.
If you say so. We've got the energy market. I mean, there's a lot of excitement due, though, isn't there, around the payrolls report, I suppose, later on today, perhaps. Energy stocks, actually, you say that fading, and absolutely that would be the assumption, given oil prices are entirely flat this morning. Brent at 77.62. But actually, the best performing sector is still energy, up by 0.7% on my screen, closely followed critically by retail and real estate. Yeah. The more things open up this morning, the more negative they look, though. We've got more and more sectors dropping into negative territory.
Absolutely, and the underperformers of this morning, and the weights, I should say, on the broader indices are going to be in your tech sector. Some of your biggest heavyweights moving to the downside is ASML, it's SAP, alongside some of your big kind of French heavy hitters as well. LVMH carrying some of your worst performers as well. But to your point, the upside is a very cyclical tilt. You are seeing Shell, BP, Total, all moving to the upside, alongside some of the banking sector as well, which I think is interesting. You've got BBVA in here, Santander, even Lloyd's, all moving higher in line with that commodity move.
Do you think some people didn't make the trade yesterday in the oil stocks and maybe just have to push that position through this morning, or maybe it didn't go through? Like, it came through relatively late in the day in Europe, those comments that we saw from President Biden.
So it did, except when you look at these, and I'm putting this in perspective, that in terms of index contribution, they are the biggest moves. But even for Shell, you're only seeing a move of 0.6%, not really magnifying the unchanged move in Brent crude.
I wonder if you saw the size of the response yesterday, which wasn't like decades ago, but there was some, and you think about what might happen over the weekend, and whether more people are assuming maybe they want more exposure to that sector going into the weekend and less of something else. But yeah, so energy stocks certainly still by far and away the best performer this morning. It's not helping the overall indexes, though, to your point. All of those are in negative territory.
Yeah, but not by much.
No.
We're waiting to see exactly what is going to be happening a little bit later on. That's the narrative. I think that's the volatility event that it's the known unknown. We don't know about it. Well, it's the known known. We don't know the answer to the question. Maybe we're on the payroll front, we've got a pretty good idea. The known unknown is the oil price. Which one of those is the key driver in terms of the volatility?
Say that 5 times fast, the known unknown.
It's going to be a struggle.
He's going to try.
Set us up with.
Let's see if our next guest can say it. Bernie Akong joins us around the table, CIO of Global Multi-Strategy Alpha at UBS O'Connor, of course, a hedge fund owned by UBS. Bernie, a pleasure to have you on the program.
Pleasure to be here.
So walk us through kind of maybe what markets are thinking here. At least this morning, the narrative we've had around the table has been there's a lot of cautious sentiment right now, not just in terms of the payrolls report today, but of course going into any sort of geopolitical risk over the weekend. Is that where you and your team is at?
I think that's part of it. I think you also briefly touched upon it before. There's this lots of other things beyond that, right? So China, when they come back from holiday, what are we going to hear out of them? U.S. elections only a few weeks away. Now in Europe, suddenly we're hearing negative rhetoric around taxation out of France and Italy. That's a lot of things and risks for investors to deal with. So it makes total sense to me that there's a general lack of risk-taking and a sense of apathy out there at the moment.
You said that keyword, the tax overhang, as well. The narrative we've heard from a lot of investors has been this is a really hard one to price because there's still a lack of clarity on what that actually looks like, what the numbers look like, and really what the impact looks like for a lot of these corporations that have already kind of been moving some of their taxation. Quantify that for us. What does that overhang look like?
You're right, it's difficult to quantify exactly, but what I would say is it's just another reason, unfortunately, to depress the European multiple and for flows to continue to come out of Europe. So I think what normally you see in these sort of circumstances is we get a lot of negative headlines, there's pushback, the politicians end up walking things back, but the damage has been done in the meantime. The multiples are impacted, and suddenly there's a bunch of investors who don't want to touch these stocks anymore. That's the problem.
Are you expecting volatility to pick up?
I do think volatility is a buy here as we head into U.S. elections. I think there have been too many dominant things in the short term which have taken the eye off the ball for investors for U.S. elections. But my view is that the two candidates are so different in their policy-making stance, and that the market is probably too comfortable by the fact that we're going to have a divided Congress.
Yeah, everybody I talk to is just like, yeah, they're divided, but ultimately they can't get anything done because nobody's going to get a sweep.
Everyone says that. That is investors. That is the consensus view. And so from my perspective, that feels like a mispricing in the tails.
Yeah.
And I also don't think we've seen in the past that the U.S. is a country and economy where the president doesn't matter, right? It's not one of those countries where literally because Congress is divided, who cares who the president is? We've seen time and again in the past that is not the case. Trump showed that to us last time around. And I think that's still going to be relevant in the future. So
China's just taught us that things can be mispriced in a big way.
Mm-hmm.
Is there further to go on that trade? Is it a zero-sum game? Do I take money out from over here and put it over here? Is it fresh money coming? What do you think about the longevity of that move?
So I think we're on the slightly more bullish perspective of that. I think we do expect more measures to come out. We see, again, the consensus view is very skeptical about the impact that these measures are really going to have. I think the important thing to think is that Xi has clearly decided he needs to pivot, recognize some of the tail risks around the deflationary spiral risk, and that change is set in stone as far as we can see. In terms of your question of is that a sort of net neutral? Do you have to take money out from elsewhere? I don't think it necessarily has to be a net neutral, but what I would say is if you stand back and think about Europe, US, and China in terms of who has my back from a fiscal and monetary policy standpoint, and political risk and uncertainty in the future, China actually stands out on those three regions as pretty positive right now, which is not something we would have been saying a month ago.
That's really interesting. So there's certainly a lot of focus then on the fiscal. It's interesting you say that the consensus is skepticism about what it really does, because the market moves would suggest there's not skepticism, or at least the market's been prepared to buy into the sugar rush in the short term. Why do you say that people are not convinced? I mean, we haven't seen a lot of detail. Maybe that's...
I would say it's from speaking to a lot of other investors, to the sell side, to reading a lot of feedback, to seeing some of the position data. I think the move, you're right, has been tremendous, but that really has been more about taking positions more from underweight basis to more of a neutral basis. People aren't willing to commit and say this is a trade or investment that I want to go overweight yet, and. I think, to be fair, people have been burnt so many times. That's why they don't want to, be making that.
You say a trade or an investment, and so that's an interesting distinction, isn't it? Because some people might be prepared to play it short term, even if they feel long term it has structural headwinds that they are not convinced will go away. How are you having conversations about that, and how you manage that?
So I think we are in the camp of there's a greater probability of it being an investment than consensus thinks, yet we're not also seeing enough detail to be definitive and say it is definitely an investment, and we're probably still more in the trade camp for now. And I think, again, that's probably where some other people are who are on the more bullish end. It's definitely a trade, but let's see whether it's going to be an investment.
Yeah.
What is the safest bet right now? In terms of hedging, what is it?
I mean, on a short-term basis, I do think it would be something like looking at, put spread on index. So skew has gone up quite a lot. So i.e. the cost of buying a put which is further out the money is much more expensive than one that's nearer to it, so you can actually benefit and add protection that way. From a lot of medium to longer term basis, I'm actually in the sort of buy gold camp. So obviously you hedge that around things like, you know, election uncertainty and Middle East geopolitics. In the long term, I think it's a hedge against you know, some of the concerns around sustainability of fiscal deficit spending.
I'm going to come back to your short-term trade. Although I'm sure Guy has thoughts on the gold one as well. That seems like a bet on vol. We were talking about what the biggest vol event is at the moment. What is it?
For me, it's elections, but then combined with the potential of actually post-elections having a very significant rotational move. We know that seasonally, coming out of an election, that sort of uncertainty fading away can really trigger big rotation. We also know you have tax loss selling season, which starts to reverse.
Yeah.
And we know that we've just had a big China stimulus announcement, and PMIs are on the floor. So is there a scenario, which I don't hear people talking about a lot, is there a scenario where we could have a huge rotation into year end? There absolutely is. And so volatility can also play for that upside, you know, event.
You mentioned it's right after the election that matters, and from a political standpoint, any sort of kind of chaos or election results or legality that is involved and largely expected to play out, by the way, from either side, depending on who ends up winning the election. Is that something you trade, or is that something you sell?
So ahead of the event, I think that's part of the reason why you own vol, right? Because of that probability of that uncertainty, which maybe people talk about but aren't really, you know, pricing or factoring into the portfolio construction. When you get to the event, we would look then to think about selling that at some point, because that will revert. Yeah.
Do you think the US economy is accelerating or decelerating right now?
I think it's a complicated answer to that. I would say that it's a very bifurcated economy. So there's parts of it, and we've seen it this year already, in terms of the lower middle income consumer classes, which are definitely decelerating, delinquency is increasing. And then there's a percentage of the economy, both on the corporate side and the high income side, which actually is doing just fine. And maybe in some parts accelerating a little bit because of the hope of rate cuts. So one of the most interesting things I hear from CEOs right now actually is, don't worry, the business is fine, even if right now numbers aren't amazing, because once rate cuts come through, my growth is going to accelerate. So there's that confidence coming through, particularly in the US side, or businesses.
Does that imply rate cuts at some point? Sorry, rate hikes at some point?
Yes, at some point, but I think it's too early to be talking about that. Yeah.
When? Okay.
Yeah, that's interesting. So we're heading towards earnings season. So yeah, we'll get another assessment, won't we, of those? Yeah, the CEO sentiment around what kind of a boost to the business rate cuts might provide, what kind of a drag taxation might provide in various different geographies. Is the earnings story going to? Well, what are you going to be watching for in the earnings story? What will be the key messages, do you think, Bernie, in terms of where we head next towards the end of the year?
For us, this reporting season is a time to already look for little clues and hints around 2025. So we like to be really, you know, forward-looking, and we think a lot of the results that will come out, you know, will be less relevant in terms of the share prices going forward. I think how the companies are thinking about business planning, particularly around headcount, will be interesting. And so to that point, I do think there's some companies which are holding back from cutting costs, cutting headcount. And that's part of the reason why I wouldn't actually be in the near term too concerned about the jobs market, only not because I think there's not risk there, but because I think CEOs are sitting there saying, rate cuts are going to come through, that's going to help my business, so I'm not going to touch it for now. And the real litmus test will come probably more as we exit through the year into Q1 of next year. If, in terms of actually is the acceleration coming through for these companies and, from rate cuts, and do they actually then need to address the cost base or not?
So you think they're happy to sort of hoard in the short term if it means they'll be ready and primed to take off in the new year? Are there new themes? Are you anticipating new themes into 2025? Because, you know, electrification and plenty of themes that we've talked about a lot on the programme, you know, that have been with us for a few years now, turbocharged by the IRA in the United States, for example. Are there new themes that you're going to be leaning into or that you're talking about with other investors?
I mean, I would say, are there really new themes, you know, like electrification, for example, we believe in a lot? Probably not, but I think what you see is a different cycle of these different themes. So, you know, for example, electrification in Europe was a, you know, hot topic maybe 3-6 months ago, went quiet, you know, now it's starting to emerge again. I think defense is another good example of that, which was a very hot topic early in the year, really quieting down. Obviously, you saw the sector pull back a lot. I think not just with the Middle East, but given the situation in Ukraine and Russia, which seems to be dragging out with no resolution, that could be an area that, you know, people return to. I think that the whole AI semis, trade and debate. There's so many moving parts around the different end markets. You know, AI data centers going great, autos, industrial poor, mobile, let's see with Apple. So I think it's the same things we've been talking about, but just the data points and the points that we are in the cycle will evolve and change, and investors' preferences will shift in that regard.
Benny, great to see you. Thanks for stopping by to see us. We really appreciate it. Really enjoyed that. Thank you very much indeed. Benny O'Connor, CIO for Global Multi-Strategy Alpha at UBS. O'Connor, thanks very much indeed. Quick look at the Core 6, see what's happening here. Talk us through some of the major stock stories. As you can see, you got Ferrari a little soft today, which is interesting. Ferrari, over the last 6 months, is the only European automaker within the sector that has posted a positive performance. Everything else is negative. I just bring that up because we're going to see that vote a little bit later on today. Elsewhere, some strength in Novo Nordisk, but as you can see, it is a flattish market today. There are some single stocks that are on the move, though, and Joe's got those.
So I've got some big moves in the shipping stocks today, Guy, following news of the resumption of work on the US ports with that 3-day strike now over for at least a few months. It will resume potentially in January if there's no deal on a pay rise. But we're seeing the stocks coming down. AP Moller Maersk down 8%. Hapag-Lloyd absolutely slammed, down 11%, and a bit of weakness in Kuhn and Nagel as well. Now, as we said, JP Morgan saying this was negative because it does mean that shipping rates will potentially ease even further. They've come down a lot since the Red Sea disruption that we've seen, but really some big moves lower in those stocks. DSV, though, going the other way following that big €5 billion share sale, doing their deal with DB Schenker, Deutsche Bahn over in Germany. They haven't had to issue more debt, and it wasn't at a discount, so potentially a positive on that one. Then we've also got an eye on another sector today. This is, of course, the EVs. So we are keeping an eye on the usual suspects over there. And then we've got BMW, Volkswagen, Mercedes-Benz. It's all gaining a little bit, waiting for the results of that vote from the European Union on Chinese tariffs. Then over in Spain, this one caught us by surprise. It is the worst performing stock today, Ferrovial, which is the big construction company. This one's sliding. There's a report in El Economista about a potential deal over in Canada around one of their roads, which they don't like the price of, according to analysts. So that does seem to be the issue. Keep an eye on that one. JD Wetherspoons, meanwhile, selling lots of pints of beer, and as a result, they are resuming their dividend for the first time since the pandemic. Good news for them, potentially priced in. That one is up 0.5% today. Then in terms of the UK banks, we mentioned earlier Goldman Sachs becoming really positive on this sector. They recommend buying NatWest, saying that the benefit from rising rates will continue in the UK for longer than it will in Europe. Over in fund management, Allfunds and Schroders are both upgraded today at Exane, which says the asset management industry is improving, mostly driven by flows from fixed income rather than equities. And finally, Teleperformance falling today in Paris as JP Morgan recommends selling this one due to the call centres' potential negative impact from AI. So that could be potentially something that reduces their business. That one declining over on the French market this morning.
Thank you very much. Thanks, Joe. Good to get an update on where things are. Some really sizable moves coming through in response to the end of that dock workers' strike, as if the market had expected that to run on for a little longer. Coming up then, we will dive into that in more detail. US dock workers agree to suspend strikes until January 15th. It's having a big impact on some European shipping companies. We'll discuss that next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. We are 20 minutes into the session. European equities are doing absolutely nothing, certainly at an index level. It's a similar story over in the United States. We are waiting for the payroll data a little bit later on. Is that going to provide some volatility? We did see some yesterday, obviously coming out of the energy sector, and it's interesting to see that London isn't significantly underperforming today, despite that outperformance, you could argue, yesterday. One of the stories that is certainly providing some catalysts for action at a single stock level here in Europe is the story surrounding the US dock workers, who have agreed to suspend their strike on the East Coast. They are, though, continuing negotiations on a new contract. Container ports from Houston to Miami have been closed since Tuesday, creating a backlog of cargo that could take around 12 days to clear. Let's bring in Bloomberg's Bill Farris to give us an assessment of what is happening here. Bill, the shock here is that this is over so quickly. Why is it over so quickly, and is it really over?
Well, as you said, it's not really over, but there is at least enough of an agreement for the dock workers to go back to work, to start working on that backlog of ships. We've already seen, as you've mentioned, that the backlog could take 12 days to clear. You had dozens of ships starting to have to set anchor off of many of the American ports. They have reached an agreement, perhaps from the workers' perspective, the most important agreement, which is to raise salaries more than 61% over the next 6-year contract. So that was one of the top sticking points in these negotiations. And the other one that they're kicking down the road until mid-January is to address the pace of automation at these ports, which of course could cost workers their jobs. That's something that they're willing to deal with as they continue to process cargo at these ports. So it's not totally resolved, but it is kicked past the election, and that's probably something many people involved with these talks wanted to get done.
It could cost them their jobs. It could also cost the Democrats the election. Put this into context for us, to your point, about the relationship between winning that labor vote and just how big of an effect it has on that election, which is about, I think, 30 days away now.
Yeah, absolutely. I mean, the election was overhanging all of this. You have you have this, you have an administration that's trying to deal with, this strike. It's dealing with the impact of Hurricane Helene. It's dealing with the expanding war in the Middle East. There's a lot on the plate. I think from the Democrats' perspective in particular, they would like to have as few chaotic events out there in the world as they possibly can. Labor traditionally sides with Democrats, but there are many parts of labor have been leaning Republican in recent years. I think the president and the administration wanted to try to get some credit for fixing this quickly and moving on. They haven't, of course, fixed everything, but they have gotten at least one issue off their plate ahead of that a November election just 4 weeks away.
Bill, thank you very much. Bloomberg's Bill Ferries with the latest there in Singapore on what's been going on in the dock workers' strike stateside. Now, the strike is over. Fast fashion, I'm sure some of that travels by ship. Zara is one of the world's most successful retailers and is widely considered one of the instigators of fast fashion. But as competition intensifies and environmental concerns in the industry grow, can it keep up its momentum? Bloomberg's Caroline Hepker reports.
These are the inner workings of Zara, a successful enigma full of contradictions.
It is by far the biggest company in Spain.
Zara is one of several brands owned by Inditex, and in an industry married to glossy, full-page campaigns, the company's ad spend is basically non-existent.
We think marketing is under 1% of sales for Inditex.
The biggest difference between Zara and its rivals, though, is its approach to logistics.
More than half of their production comes from what they call proximity.
That'd be markets closest to its headquarters, so Spain, its home market. And here, and here, and here.
And what that allows for is much more rapid distribution into stores.
The biggest challenges for Zara and the industry as a whole are twofold: the rise of Chinese fast fashion powerhouses and fast fashion's devastating effect on the planet.
Given the sheer volume that is produced by retailers like Zara, it undoubtedly will impact its environment. It's also been criticised as promoting overconsumption and a culture of waste. And one of the ways that retailers are looking to push back against this negative image is by creating all sorts of pledges. So Zara, for example, has pledged to reach net zero emissions by 2040, and it's also introduced a repair service. But the question is whether or not that is enough.
Bloomberg's Caroline Hepker there reporting. You can watch the full, that's just a cut-down, briefer version of the full mini-documentary that's available certainly on the Bloomberg Originals YouTube channel and elsewhere, so you can check that out. Back to what's happening here and now in markets. We see a pop in one stock this morning that has just IPO'd, up by 7.2% for Springer Nature. Yeah.
Is this an IPO I see before me?
It is.
We haven't seen too many of them. It's interesting to see that we are seeing one coming through.
In the open.
Precisely, certainly a rare spot. And it can be done, and it can deliver a pop, and it's amazing to see it happening because it feels like we haven't seen something like this for a while, and it speaks to the wider picture. You take a step back from this about the struggles that private equity is having for exits at the moment.
Well, I think that speaks to this. I mean, this is the second largest out of 4 IPOs we've seen this year. Our team tells me.
It's October.
Exactly, and
yes.
in the German market specifically.
And we keep an eye out what's going on with Shein, because this could be an interesting one for the UK market. Of course, turned away from the United States by a slightly lukewarm reception there. But we understand from our latest reporting that Shein is said to be planning investor meetings ahead of a London IPO. So we could be seeing more action in London on that front too. Coming up on the programme, EU member states are voting today whether to impose 45% tariffs on Chinese EVs. We take a look at why the bloc is split next on which countries are backing this move and which don't. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is the opening trade about 30 minutes into today's session. Seeing some green on the screen, but light volume seems to be the name of the game. A lot of cautiousness ahead of that jobs report in the States, geopolitical risk over the weekend, and of course, what is happening in the EU today. Let's get right to it. Germany reportedly planning to vote against the EU tariffs on Chinese electric vehicles later today. Now, earlier this week, German Vice Chancellor and Economy Minister Robert Habeck warned the proposal could lead to a trade war. Take a listen.
I would agree with everyone who says that tariffs are not the answer. I see now a development of new trade barriers everywhere. So tariffs are not only invented, or the threat of inventing tariffs and the potential counteraction from China is not only happening in Europe. I see the colleague from Brazil. Brazil has given tariffs on Chinese cars. The US 100%. Turkey has done it. India has done it. If we are honest, we see that the phase of open market globalization is entering a new stage.
Meanwhile, French President Emmanuel Macron has reaffirmed his support for the tariffs, calling the level of Chinese subsidies, quote, unbearable. Let's get more from Bloomberg's Craig Trudell joining us around the table today. You picked a good day to join us, a good 48 hours to join us. This fragmentation you're seeing in the core of Europe that's supposed to be showing united front really falling apart. What do we expect today?
Yeah, I think the general expectation I would say is I do think that these tariffs will go ahead. It is amazing. We were talking during the break about the surprise that Germany is caught on the other side of this. I think the German manufacturers, have the most to lose here and the most at risk, in the sense that there's real sort of writing on the wall that if the EU goes ahead with this, large engine cars would be hit with retaliatory charges, and that would hurt the likes of Volkswagen and Mercedes and BMW. Companies like Porsche, companies like Ferrari. So this would have wide-ranging ramifications, even if the volumes of those cars are not necessarily massive, and have been trending in the wrong direction. I should note too that all of these trade tensions have sort of coincided with these companies really losing traction in the Chinese market.
Craig, do you think that European policymakers, if they do vote for this to go ahead, are they doing this because they think this is a short-term sort of sticking plaster Band-Aid that will allow the European manufacturers to sort of recover a little, rebuild and try and fight back? Is that what they're worried about here? They don't want China to get in and get market share, and maybe they roll them back later. Is that the thinking?
Yeah, I think that's generally the case. The tariffs themselves will be in place for 5 years. And so I think, when you look at that and sort of, think about how they've been crafted, it maybe does sort of give them an opportunity to get on more level footing and 5 years from now be able to compete without, tariffs necessarily sticking around. But I think it's already the case that we've seen significant traction, for Chinese imported cars in Europe, where they've gone from a fraction of electric vehicle sales in Europe to something like 20% last year, just that sort of subsegment of the market. That includes some companies like Tesla that, of course, are not Chinese companies themselves, but are importing from.
BMW does a bit of that, doesn't it?
BMW does a bit of that. Renault does a bit of that, and so I think there was a concern that not only was there a risk of Chinese companies posing a real threat, but European companies also leveraging the lower cost base of China at the expense of jobs in Europe.
Does this make it more likely or less likely that Europe will push back its CO2 targets? If Germany's not getting what it needs here, is the next kind of angle of attack from the German point of view to say, that's fine, but we need to push these targets out? And the fact they didn't get what they want here, does that make it more likely potentially that those targets, they will get what they want there?
It's a great question. I mean, I think the manufacturers, we've already heard a lot of gnashing of teeth of, we just can't meet these numbers. And, one of the big problems that we're seeing is that, EVs are still too expensive. In order to bring prices down, we need to leverage a lower cost base. That probably means at this point, given what China has pulled off with, bringing cost downs within the supply base, particularly with battery costs, you just can't make an EV as inexpensively in Europe as you can in China. Therefore, you can't offer them cheaply, and therefore sales are going to be not what they need to be for these companies to comply.
So what does pushing out CO2 targets look like? You must talk to a lot of people within the industry. I'm hearing that conversation growing louder and louder. What is the expected timeline? How quickly is that a this year thing? Is it a next year thing? How long are we going to push the targets out for?
I think there's a lot of attention that's paid to 2035, and for the obvious reason that that is the target that's been set for going to zero. But along the way, I think that the big key that the manufacturers are worried about in the here and now is 2025. The CO2 limits become more difficult, and so pushing that more stringent restriction on CO2 emissions needs to be relaxed in order for these companies to avoid what could be massive fines if sales trends of late hold.
Particularly, it's interesting that the car makers are basically saying the argument I hear, you either give us subsidies, which they're not going to do because they don't have the capacity to do so, the budgets aren't there for that, or you basically have to roll these targets back. Craig, thank you very much indeed. Bloomberg's Craig Trudell on the vote that we're going to be seeing this morning. Agatha Krantz, Director of the Rhodium Group, joins us now, where she leads research on EU-China relations. Agatha, thanks very much indeed for joining us. Let's talk about these tariffs that are likely to be applied a little later on today in Brussels. Are they going to be big enough to deter the big Chinese manufacturers?
So the levels that are going to be applied are going to be different depending on the company. You have actually about 3 levels of tariffs, about 7-8% for Tesla, between 17 and 20 for some of China's EV makers, and then the highest end of 36 for SAIC in particular, which is one of the biggest exporters into the EU. At the lower level, this is going to hinder a little bit the growth of Chinese EV makers into the European market, but it's not going to make a very big difference in the long term. The price differential and the price competitiveness really high. For SAIC, which is really, once again, one of the biggest kind of China-branded exporter into the EU, yes, it will make a big difference, and this is why China is fighting very hard here.
Okay, so if this doesn't have an effect over the long term, what other steps can Europe take?
At the moment, they're, of course, negotiating, and they are saying to member states that they will keep negotiating with China to try and achieve a negotiated solution that would involve probably a minimum import price level being set on Chinese imports. and potentially some tariff-based quotas. That is a little bit more complicated under the WTO, but the minimum import price would be a way to make sure that those cars actually get into the European Union at a high enough price that European car makers based here in Europe have a chance, a fighting chance. At the end of the day, though, if that minimum price is too high, Chinese automakers might decide not to go with it and not to abide by the agreement and just take the tariff. So that's the difficulty here. There's not really a good negotiated solution for the moment. And this is also why the vote is so important today, because at the end of the day, the baseline and the most likely case is that we're going to see duties put in place for a little while, but for a number of years.
Agatha, you use that key term quotas, and it really struck a tone with me, because there are currently steel tariffs right now between the United States and Europe that are also on ice, but only on the condition that your quotas are filled from Europe to the United States. And I'm curious, as a tool, how effective that is in your view, and whether or not that's a tool that could be used in the coming years.
It's a very tricky tool because it's not a WTO compliant tool, right? You think about quotas, you think about what you call voluntary export restraint. That's the way that back in the days the US and Japan dealt, the US and the EU dealt with Japanese imports of cars, right? It's a story that's been told and that's been running in the past as well. But since then, the WTO has made quotas or voluntary export restraint actually illegal. And so you have to use quota-like measures, once again, like tariffs that are set on a certain number of cars for a certain moment that create quota de facto, but aren't exactly called a quota. So that's an option going forward. It's actually one of the better ones, if you ask me as an economist, just purely looking at the prices of Chinese cars, the price advantage, because then it limits the market share that they can get into the market, and it kind of sets aside a share of the market for European makers. Whether or not they can make that, once again, WTO compliant, this is something that the EU is very, very kind of concerned about at the moment, more so than the US. In the current context, is a big question. I think one of the things hanging over this negotiated solution. So we'll see, but that would be one way to go.
What about the security component of this, Agatha? I think we've got comments this week coming out of some of the major players out of Brussels as well, talking about it's not just in terms of overcapacity in the market, it's also about other tools like AI and other software that is really embedded in some of these new models in the EV story. How does that play a role in these conversations, and how can Brussels really regulate that aspect when their own regulations around regular AI and regular software still haven't caught up yet?
Well, this is something that's very, very timely at the moment, because a week ago the US released the result of an investigation that it calls an ICTS investigation. But pretty much what it does is it says China-made vehicles or China-made auto technology is concerning to us because of the cyber data leakages, sabotage, and espionage risk that go with connected vehicles in general, right? I think some of the EU at the moment have that concern as well, and there's actually a risk assessment going on around connected vehicles in Brussels to try and understand what the risks are around those vehicles. And the jury's out there. The problem is national security measures like cyber protection, like the ICTS investigation the US is undergoing at the moment, would be implemented at the member state level. And so if all member states decide to do the same, it's good. But if some member states decide to not restrict Chinese cars, but others decide to restrict them, we're in a Schengen area where those cars can cross borders. And so that gets very, very complicated to limit. Now, if and that's hypothetical, but if the EU were to decide or to conclude that connected Chinese cars or connected Chinese technologies were, too dangerous to apply in the EU, then that would be a complete market ban, right? What we're facing in the US is a complete market ban on the basis of technology, cyber risk, and data risks.
I guess, given your experience of China, how would you expect China to respond if we see Europe go ahead with these tariffs today? I mean, we've had a few clues as to some of the levers they might pull. Do you think they'll respond in the auto space, or will it be much broader than that?
So they've already waged and stated a lot of threats, right? They've opened 3 investigations, one into brandy, one into dairies, and one into pork products exported from Europe into China. And so they could just go ahead and place tariffs on those products. They've also made very clear threats to German automakers that their imports, as you were explaining, imports of ICs into China of some of the very high margin cars that those guys produce would be affected. And then there's a whole range of things that China could do, right? It could go after machinery made in Germany, it could go after cosmetics made in France, it could go after wine. There's a whole lot of list of targets, right? And so it could, as a matter of fact, start a trade war. The problem, and maybe the way to think about it differently is Europe is saying we're still going to continue negotiating. And so does China want to actually escalate at a moment where the European Commission is saying, let's keep talking, let's keep seeing if we can find, once again, a minimum price solution or a quota solution. And also at a moment where, well, China's economy is extremely weak, right, in terms of the latest macro data, but also inbound investment has fallen off a cliff. And so do they really want to spook foreign investors, and especially European foreign investors, which are really the only ones left standing at this stage in China?
Okay. That's an interesting. And what will the response be from Chinese car makers? I know that BYD, for example, plans a factory in Hungary. Are we going to see a lot more of that? A lot more Chinese car makers coming to Europe to try and propose to build factories? And will they get a warm reception?
So the first thing is some of them will eat up the duties. As I said earlier, the 20% level for some of them is actually acceptable and quite okay. Others will set up probably factories in Europe the way that the Japanese had done back in the days. There will be a question here, though, at the EU level. Again, we're not at the end of those tensions because European member states are going to want to make sure that those are not just kind of screwdriver factories, right? That it's not just bringing all of the materials and the inputs, putting them together in Europe and then putting them on the market. And so I think there's going to be kind of a second battle here with member states trying to get as much local content, local employment, local technology as possible so that you get the most out of those investments. It's a little bit of a process of turning the tables on China, right? Because that's precisely the way that China has been dealing with foreign direct investors for decades now. So that would be really interesting to watch.
And the Chinese authorities have made it clear to their car companies that they should not take any of the high-end technology and export it into Europe. The Chinese can maybe see that one coming. Agatha, thank you very much indeed. Agatha Krantz, Director at Rhodium Group, thank you very much indeed. It's kind of a related subject. Let's check in and see what's happening with the shippers this morning. This is as we see the port strike on the east coast of the United States coming, it appears, to a conclusion. We are seeing freight rates maybe falling as a result of that. That is being priced back into the European names this morning. As you can see, we are dropping off on this. It's happened a bit more quickly than anticipated, Chrissy, the end of this, the conclusion of this.
Much faster. This went from months to days in terms of the effect. But does it simply kick the can down the road to, I believe, January 15th now? And especially once the election is over, does that change things from the new president? All that going to hit, of course, the labor story. Coming up on the program, we're going to stick with that labor story. It is, of course, Jobs Day in America. Investors looking for detail on the labor market as hiring is expected to pick up. But estimates on the range, pretty wide. We're going to dive into the preview of those numbers next and even the market reaction that follows. Stick with us. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped. and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. We are 49 minutes into our European trading session, and we have some modest gains across European equity markets, up by 0.3%. US futures are a touch to the upside, but really not much in it. We're waiting, of course, for the data print of the day, which is the non-farm payrolls report. Valerie Teitel, who we've already told you is back today, and great to see you on screen with us, Valerie. So let's get straight into it. Great data to return to screen, given that there's the non-farm payrolls number to talk about, and a huge spread. We've talked about this with some of our guests. There's a lot of uncertainty attached to this number, perhaps, today.
A lot of uncertainty, a lot of pressure on this print. Jerome Powell, himself has put more and more focus on the labor market in the last few weeks. The spread, as you mentioned, going from 70K all the way to 220. A lot of that has to do with these seasonal adjustments we get in September, but also the revisions. We've had such steep revisions to many of these reports, all but one, I think, this year has been revised down.
And the revisions move the markets.
And they do, the BLS revisions, even end of August, really shook up the market when they took them 70K down per month, basically, all of last year.
Yep.
So a fairly wide range on these estimates. But in terms of market reaction, is it also a wide range from the volatility we're expecting, at least in the short term?
It just depends. I think I'm more mindful of an uptick in the unemployment rate to 4.3%, causing the market to go back to 50. We do get some Fed speakers this afternoon as well. We hear from Fed Williams, also from Goolsbee, who's doing an interview with Bloomberg. He's the big dove, right? We've heard from him a lot. But maybe if Williams changed the tones after this print, they've said, I guess, before the press conference from Powell earlier this week. We really thought the Fed was going to be there to save the labor market, but his comments were a bit more hawkish this week. Is that going to be repeated from the other Fed members later today?
Where does the surprise come from? So you told us we need to focus not on the 4.2, it's the 4.2 what? Because that could take us to 4.3. Because the last number was 4.2. What was it?
4.23, I believe. It was
We're really getting into a lot of decimal places here.
But the market's going to look at this and go, we get to 4.3. That could provide us a bit of a surprise. Mm-hmm. How hard is it to get to 4.1? And I'm wondering kind of the symmetry of the risk around all of this. The labour market, the data recently has shown some improvement.
Yeah.
What happens if this shows up in these numbers? How shocked will the market be if suddenly we don't need to worry about the labour market and the labour market's looking all right?
Yeah, but on a broad trend, the payrolls have been declining. If you look at a 12-month average, a 6-month average, 3-month average, the labour market is cooling. So I don't think anything today is necessarily going to change that narrative broadly. I think that we're just going to be way more focused on any teeny tiny cracks because Powell is focused on any teeny tiny cracks.
He's focused on it, and everybody is focused on the labour market. But then the point we keep asking our guests about is, are we in danger of ignoring inflation at a time when oil prices are rising? And we see that once again today. When we started this programme, oil prices were flat. We're now up by 0.8% at 78.21 on Brent. This has been more than an 8% climb just this week, Valerie. I mean, this has the potential to spark new conversations in the United States.
It has the potential, but Anna, this move does need to be sustained for a few weeks in order to show.
Pooja Kumar was telling us earlier, it has to be a quarter for it to really be material. That was in a European context, but still.
Yeah, to show up at the prices as the pump and then affect consumer sentiment and then affect spending. You know, the rise really does need to be sustained, and maybe we'll get another escalation over the weekend, and we do see a sustained rise in the oil prices, and that becomes more part of the conversation even within the Fed.
Is that an isolated commodity story now, or is there still that read-through or that relationship into the equity market, the bond market, Fed pricing, et cetera, or is this still kind of a oil story?
I think at the moment it's very much an oil story. If you look, for instance, on the days that we did get those big jumps higher in oil, the U.S. front end didn't really move at all. So at the moment, we're not really connecting the commodity move directly to Fed policy. They aren't moving in tandem. They're moving on different topics. But I think it could take, another leg higher where we do start to raise an eyebrow when it would affect Fed policy. But I think we're a little far away from that at the moment, Grady.
So we're going to get through payrolls. We've got to think about what could happen over the weekend in terms of the geopolitics. All of these events certainly going to be on the market's mind. But we do have a weekend coming up. So there's a few things that we should maybe be thinking about as our weekend starts. The Joker 2, Folie à Deux, Delusion for Two, coming out. I'm not sure you're going to go and see that.
I'm not, only because I don't want to do scary movies. But I hear Lady Gaga and Joaquin Phoenix are in it, which is quite the combo.
Yep. So that's going to be quite the combo. Apparently, it's quite dark. So maybe something to incorporate with other things that are slightly more cheerful. You've got the wrapping up of the America's Cup. So this is the kind of the Louis Vuitton Cup.
This is what excited you last week.
It is. So we're coming to. You've got to get to 7 points. We're nearly there.
Tell Critty it's in Barcelona. Then she'll.
It's
be
in
excited.
Barcelona.
Now I'm excited.
It's sailing. It's sailing. It's in Barcelona. Then you get to basically challenge for the America's Cup.
Why are we not there? Take the show on the road.
I don't know.
We maybe should be in Stockholm. They've got an event taking place this weekend. Next week is the prizes being given out.
Yep.
So they're kind of Stockholm is dealing with
beating
that.
the drum to the Nobel Prize.
Nobel calling. So we're kind of beating towards that. And there's a couple of drinking themes that we should probably roll in here as well. It is cocktail week in the UK, but Oktoberfest is wrapping up on Sunday in Munich. There's an NFL. If you're not going to watch the Joker, are you going to watch the NFL game that's taking place here in London?
I'm going to London Cocktail Week. Come on. I mean, it's like you don't even know me. And I think, to be honest, it feels like all the drinkers are leaving Germany and maybe coming to London this weekend.
The producers took
or maybe
that out.
They never left.
They took London Cocktail Week out, and I think that's
highlight.
actually what we're most excited about.
Poor editorial.
Valerie,
Valerie says she's not into cocktails because they're not strong enough.
What is your drink of choice, Valerie?
Hey, we like the warm British beer over here, don't we?
Yes, we do.
That turn.
Guy definitely does. It's intentionally that way.
No. I'm a gin and tonic kind of gal. I don't know what about you, Anna?
I won't divulge all of the above. My
all
head,
of the above.
My head, not all at the same time. I feel really boring because my head has just been turned by a move in the Volvo car share price. Given we're focused on EVs, but that's
Anna's drinking and driving.
No, that's not where we want to go at the end of the programme. But I'm glad we've set everybody up for the weekend with London Cocktail Week, Oktoberfest over in Munich, plenty to
American football.
Yeah, and just a rest, just a good sleep, I think, is on the cards for the weekend. A lot of news.
Yeah.
Too much news.
We would probably be sleeping, I think, too much of the weekend, because there's actually a lot to pay attention to this weekend. The geopolitics, I think, is going to be something that the market is going to be very nervous about. So do you put risk on post-payrolls, or do you wait for that geopolitical story to put risk on?
And Guy, don't forget, we have CPI and the Fed minutes next week, which will give us
deal with
a
that
hint.
next week, Valerie.
Give us a hint on why they went that 50, which I know you were against them cutting 50.
How long after we get the payrolls report will it be before someone says, well, we'll have to wait and see what CPI tells us?
It's just happened.
We got to get our weekend rest before that first. Bloomberg Valerie Teitel, we thank you so much. Coming up in the next program, we're going to have an interview with the CEO of Robinhood. They're reported to be launching margin trading in the UK the next couple of weeks. That interview coming up on The Pulse at 9:30 a.m. London time. That does it for the opening trade. Stick with us. This is Bloomberg.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Jobs Day in the U.S. Investors await today's crucial data that will help shape the path ahead for interest rates. While oil adding to gains after its biggest one-day jump in almost a year, markets rattled after President Joe Biden says the U.S. is discussing whether to support potential Israeli strikes on Iran's crude facilities. Plus, decision time, the EU votes on whether to impose tariffs as high as 45% on electric vehicles from China. Now, also coming up today, we're joined by Vlad Tenev, the chief executive of Robinhood. We'll, of course, discuss the company's first 6 months in the UK, any future plans, and actually how they see the investing landscape change. That's in about half an hour, 9:30 a.m. London time. First thing is first, let's take a look at the European markets map. And actually, a lot of these equities are fluctuating. This is because of the geopolitical tensions, a lot of expectations.
Hey, ChatGPT.
Hello there. How's it going?
It's going really well. Today, I'd really like your help solving a math problem.
I'm all ears. What math problem can I help you tackle today?
So I'm going to write down a linear equation on a sheet of paper, and I'll show you. And then I'd love your help working me through it. But importantly, don't tell me the solution. Just help give me hints along the way.
Got it. Okay, I see it.
No, I didn't show you yet. Just give me help along the way. 1 second.
Whoops. I got too excited. I'm ready when you are.
So, ChatGPT, what equation did I write down there?
Ah, I see it now. You wrote down 3x plus 1 equals 4.
Yep, exactly. So what's the first step I should take to try to solve this?
The first step is to get all the terms with x on one side and the constants on the other side. So what do you think we should do with that plus 1?
Okay, I'm going to try to subtract 1 from both sides, and then I'll see what I get.
Great idea. Perfect. Now, what do you get when you subtract 1 from both sides?
Okay, so ChatGPT, this is what I ended up with. How does this look?
Spot on. Now you've isolated the term with x on one side, and it looks like 3x equal 3. What do you think we should do next to solve for x?
I'm not sure. Can you give me another hint?
Of course. You have 3x, and you want to find the value of x. Think about what operation would undo multiplication.
Is it subtraction?
Close, but think of the opposite of multiplication, because 3x means 3 times x.
Okay, I think it's division. Let me try to divide both sides by 3 and let me see what I get.
Bingo! Go ahead and divide both sides by 3.
Okay, so ChatGPT, this is what I ended up with. How does this look?
It looks perfect. You've solved it, and x equals 1. Nicely done. How do you feel about solving linear equations now?
Yeah, honestly, I'm not pretty confident I can solve linear equations, but why would you ever need to use this in the real world? I'm really skeptical.
That's a fair question. Linear equations pop up in a lot of everyday situations, even if we don't realize it. For example, calculating expenses, planning travel, cooking, and even in business for profit and loss calculations. It's basically a way to solve problems where you need to find an unknown value. Plus,
wow,
it's...
okay. You know, I have a lot of unknown values in my life. I'm totally convinced I'm going to learn math now.
I love that attitude. Math can definitely help solve some of life's mysteries. Whenever you're ready to dive into more math, I'm here for you. Anything else you'd like to tackle today?
So ChatGPT, I really love that you taught the value of math to my friend Mark. And I wrote one last thing I'd love if you could take a look at.
Of course. I'd love to see what you wrote. Show it to me whenever you're ready.
Okay, so this is what I wrote down. What do you see?
I see. I love ChatGPT. That's so sweet of you.
Yeah, well, I really appreciate all the help.
A very big catalyst for short-term moves, but I think global investors, beyond the immediate geopolitical context that we always have to learn how to work with in an asset allocation context, is also supplemented with some of these longer-lasting support measures.
Nanette, I'll ask you about U.S. jobs in just a second, but how much more volatility are you expecting from now until January, given all the geopolitics that is, again, very difficult to read, especially if oil facilities could be touched, and the U.S. election coming up November 5th?
I think we ought to prepare for some more volatility. We've seen actually the VIX already start reflecting that. And to be honest, I've been not only watching the labor market as a source of fluctuation because of the pivot of the Federal Reserve now much more onto the labor market, but I'm also sensitive to the fact that U.S. 10-year break-even inflation has been picking up again from the 2% it had reached recently to, again, 2.22%. And of course, there is the short-term fluctuations that may be coming from commodities, that may be coming from energy prices, but certainly these long-term inflation expectations are also going to be determining the pace that the Federal Reserve will continue to take with respect to its future rate cuts. And therefore, I think both sides, inflation news as well as labor market news, will continue to provoke the markets to react. And of course, geopolitics, insofar as they do have an impact on energy prices, will be one of the possible sources of volatility.
Nanette, thank you. Keep it right there, because the latest U.S. jobs report, as you're saying, is due out later today at 1:30 p.m. London time. Bloomberg Valerie Teitel also joins us for more on what to expect. Hi, Val.
Hey, Francine, good morning. It's a big day for the markets. We get the release of the September jobs report at 1:30 UK time later this afternoon. The estimate is for 150K jobs added to the U.S. economy. The unemployment rate is expected to stay the same as the prior month at 4.2%. Same story with average hourly earnings expected to stay the same as the prior month at 3.8%. But the range of the predictions on this number today, Francine, has been wide, going from 70K all the way to 220K. That has a lot to do with some complicated seasonal adjustments that take place this month, which make it hard to predict. But I urge you also, Francine, to look at the revisions that come out as well today. The revisions have really shocked the market in the past few months. All but one of the revisions this year has been to the downside, has been lower. So that might catch the market's eye. What also could catch the market's eye, Francine, is even the second decimal on this unemployment rate if we do get a tick up to 4.3%. Now, why is there there such laser focus on the labor market? It's all because of what Powell has been saying over the last few months. I want to remind you of his specific words that he used back in Jackson Hole, saying we do not seek or welcome further cooling in labor market conditions. He went on to say in the Q&A just 2 weeks ago that the single most important data that comes to the Fed into changing their decision making will be the unemployment rate. I've got a chart coming up next which shows the trajectory of the unemployment rate. It has been on a rising path, and Citi does see a chance that the unemployment rate could rise not to 4.3% but to 4.4%. And they specifically point to the weakening labor market sentiment when it comes to the Conference Board indicator of jobs too hard to get. That is this blue line here, which has been on a continual trajectory higher, which could lead the unemployment rate to take an unexpected leap higher today.
Thank you, Valerie. Nanette, when you look at some of the expectations that you were talking about, of course, in the Fed and the Fed cuts, is there a concern that they're actually cutting into a recessionary environment? I know we focus so much on some of the data, we focus so much on the cuts that we sometimes, forget the narrative and like what kind of economy are we left with at the end?
I think the likelihood of a recession remains relatively contained. I mean, take a look at what the ISM services have told us. Most developed markets, and the US is certainly in that camp, is really depending very strongly on its services sector, much more than on the manufacturing. And services is all about jobs. It is all about giving also consumers in the US, which is one of the pillars of US growth, a very good backdrop. So I think that recession risks at the moment remain contained. It is really this balance in the dual mandate of the Fed between the inflation target that they're pursuing and then the support that they're able to give to the labor market and the real economy at the same time. For now, I would anticipate that the 0.25% reduction in November and another 0.25% remains a good base case to assume for the Federal Reserve in this balance of the two for the coming months.
Nanette, when you look at, I guess, some of the possible tariffs, given what Donald Trump has said that he would do if he becomes president, but also the fact that there could be attempts from Donald Trump to sway the Fed going forward, is the market going to react to some of these things as we approach November 5th, or do you think largely they'll just look through it until we actually know what policies will be put in place, depending on who's in the White House?
Scenario analysis is very important, and understanding how the two presidential candidates and the economic policies that are part of the campaigns are going to impact some of the determinants of inflation and of growth, which are both really critical for what the Federal Reserve can continue to do, is important. I do think that there are differences between the two possible outcomes in U.S. elections this time as far as inflation expectations are concerned, and certainly tariff policies or trade policies that are influencing prices of goods, but also migration policies that may be influencing, even if it's only temporarily, labor market conditions, is going to have an impact on the Fed. And so we would see differences here, for example, in terms of how quickly and how low interest rates by the Fed can fall in 2025, depending on who will end up in the White House and with what Congress composition that candidate is going to work with.
Nanette, thank you. Nanette Heschel-Fighter from Lombardier stays with us. Now, coming up, oil prices pretty steady after a roller coaster 24 hours. We'll give you the latest on the conflict in the Middle East next. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back, everyone. Now let's focus on oil, gaining this morning following its biggest one-day jump in almost a year yesterday. Now, this is after comments from President Biden when asked about supporting potential Israeli attacks on Iranian crude facilities.
Do you support Israel striking Iran oil facilities, sir?
We're in discussion of that. I think that would be a little, anyway.
Now, we're joined by our EMEA News Director, Rosalind Matheson. Ros, good morning. What do you make of those comments?
Well, it's interesting because he revealed several things in very brief remarks that were slightly muffled, a bit hard to hear. One was that he confirmed that there is a discussion around hitting oil facilities in Iran. The US is obviously part of that. He also, at some point in that conversation, indicated he didn't expect the strike, by Israel that will come on Iran at some point to come soon. So he put a bit of a timeline on it. But the remark where he said anyways to me was quite interesting because he sort of indicated, was he indicating that Israel will do what Israel wants to do? What can the US in the end do aside from making, one thing very clear, which is that they would not support Israel striking Iran's nuclear facilities because the US would have to help with that. But the rest of it anyways, what in the end can the US do because Israel will, act in the way that it sees fit. So that to me was a bit of a telling comment.
So, Ros, what happens next? I mean, I know this is wildly speculative, but we're expecting a response, and then this could come from both sides, one after the other.
Well, that's right. We're just in this series of tit for tat that's been going on for many months now in terms of the direct actions that Iran and Israel are taking against each other. And obviously Israel will say, given the ballistic missile strike that it had earlier this week from Iran, it has to respond to that, has to respond somewhat in kind. It's all this chessboard of how do you calibrate your responses to kind of be at the same level of what you just received, but also not to escalate that much further. And given that these were ballistic missiles, so less warning for Israel, they can come pretty fast. Some of them did seem to get through. Israel have to do something they consider to be at least proportionate to that. So they can't just send drones again to an Iranian, military site and call themselves done. So what will that be? Sort of further, military sites? Will it be oil sites? Obviously very important for the US too, given the oil price right now. Will it be something through proxies? We just don't know.
Okay, so we'll be here and, of course, bring you any news that we get from that. Ros and her team, as always, on top of the news. Ros, thank you so much. Ros Matheson, Bloomberg's EMEA News Director. Now, still with us, Nanette Heschler-Feider, Chief Investment Officer for EMEA at Lombard Odier. I guess the concern, Nanette, is that actually we're not really sure what happens next. And so there's a lot of risk. There's a lot of concern. There's a lot of question marks for investors. How do you protect a portfolio?
I think the good old premise of being well diversified is absolutely the starting point. And also taking a look at where the risk rewards are still compelling. Right now, by way of protection, precious metals and gold are one of the areas that seem like a good idea to have in the portfolio. Why? Because we do have a rate cutting cycle. The dollar accordingly is stable and not so much of a headwind. And this is one of the safe haven assets that are working really quite well when the world is becoming more uncertain. Also, a number of currencies, exposures to currencies like the Swiss franc or the Japanese yen are helping to stabilize through, especially if you are having a positive view on what is happening in Japanese equities, for example. So this is about diversification. As far as risk rewards are concerned, I always like to look at the fact that for now, corporate bond yields in the United States are offering much better yields than earnings yields on equities. So fixed income continues to have this absolute relevance in well-diversified portfolios as well.
Nanette, I mean, what does it mean for Europe? I know there's also a number of question marks over, tax-raising measures, certainly from France and other European countries. So do you stay away from Europe?
We are overall underweight Europe, not so much because we're expecting bad returns, but because in other regions there may be better ones. But to be completely outspoken, European equity markets have done pretty well if you look at them overall, and if you take a look at peripheral European equity markets, they've actually been on fire this year. So I do think that there is some catch-up potential for some of them. Certainly, as far as France is concerned, as far as some of these corporate taxes are concerned, you have to weigh the impact of the positives as far as credit spreads and the sovereign credit spread is going to be, how this is going to impact risk assets overall in France, and then also what's the direct impact of corporate tax raises on the equities and the profitability of the companies.
Nanette, as always, thank you so much for joining us. Nanette Hechler-Feiderb from Lombard Odier. Now, coming up, U.S. dock workers decide to go back to work, but as talks continue, another strike is not fully off the table. So we'll have the full story next, and this is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Well, U.S. dock workers have agreed to suspend their strike while they continue negotiations on a new contract. Containers ports from Houston to Miami have been closed since Tuesday, creating a backlog of cargo that could take 12 days to clear. Let's bring in Bloomberg's Bill Ferries. Bill, hi. How was this resolved so quickly, and what's actually left to be negotiated?
Yeah, so the strike really just lasted about 3 days. As you mentioned, it's not officially over. Workers are going back to work, to the job, after securing a 61% pay increase over the next 6 years in that 6-year contract. They have not resolved their concerns about automation at the ports, something that could cost many of them their jobs. That's the part that will continue, but they've set a new deadline of mid-January for that. So it gets the ports back functioning. It gets them working on that backlog of ships that they think could take about 12 days to resolve. But it does get also the American economy past this immediate crisis with the shipping industry.
And with the presidential election just a few weeks away, what political impact did the strike and its resolution have on the campaigns?
This was definitely a problem the Biden administration wanted to take care of very quickly. They're already dealing with the aftermath of Hurricane Helene. They're trying to deal with the expanding crisis in the Middle East. They did not need a major economic and labor issue potentially disrupting the campaign just 4 weeks out of the election. So this deadline for finishing the talks on automation, that is kicked back well past the election. It's something that the next president, whether that's Kamala Harris or Donald Trump, that they'll have to deal with. But it does kind of negate that as an issue for Democrats heading into the November vote.
Bill, thank you so much. Bill Ferries there in Singapore. Now, coming up, we speak to Vlad Tenev, the chief executive of Robinhood, on markets and changes to the retail trading offering in the UK. It's going to be a good conversation, actually probably my conversation of the week. So don't miss that. That's next, and this is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. It's Jobs Day in the U.S. Investors, of course, awaiting today's crucial data that will help shape the path ahead for interest rates. Oil adding to gains after its biggest one-day jump in almost a year. Markets rattled after President Joe Biden says the U.S. is discussing whether to support potential Israeli strikes on Iran's crude facilities. Plus, decision time. The EU votes on whether to impose tariffs as high as 45% on electric vehicles from China. So we have a packed show today. It's now roughly 6 months since Robinhood launched its UK offering. Well, Bloomberg Intelligence says consensus sees the retail trading platform's revenue jumping by 40% this year, even as net interest income tailwinds fade with U.S. rate cuts. Well, I'm very pleased to welcome Vlad Tenev, Robinhood Chief Executive Officer. Vlad, so good to see you in London and so good to see you in the studio. You've been here for a couple of weeks. So talk to me about what you're offering to the UK. You've rolled it out about 6 months ago. How's it going, and what more do you have planned?
Yeah, thank you for having me. Always good to be here in London. I think for the UK, the value proposition is really Robinhood's the best way to invest in U.S. markets and U.S. dollars. So we're offering trading and investing in U.S. stocks. And we have a particularly innovative offering that we call 24-hour market, which allows over 1,000 symbols to be traded around the clock. Particularly useful here where there's less overlap with U.S. East Coast market hours.
But so, Vlad, when you look at, at the moment you allow consumers to invest in U.S. stocks, are you going to open that up to other asset classes?
Yeah, absolutely. So the first priority is making all of the great functionality that we became known for in the U.S. available to U.K. customers. So margin investing in particular is coming in the coming weeks. There's been a huge demand for options as well, options on U.S. equities, because that's just hard to come by here in the U.K. market. So we really feel like we can differentiate with U.S. offerings. But of course, we're looking ahead to multi-currency wallet support and local execution, including the London Stock Exchange.
I mean, it's exciting. So in what kind of time frame? I mean, so margin in a couple of weeks.
Yeah.
And then every couple of months, something more?
That's the idea, yeah. Every couple of months. I mean, we have a long backlog of things, and we're continuing to build new things. So we've talked a little bit about new asset classes that are likely going to come to the U.S. first, like futures trading. But really, we think Robinhood can offer a differentiated service for UK investors who want exposure to broader global markets.
Vlad, we've been talking a lot about IPOs and the fact that the IPO market in the UK and London is a bit meh. It's like it's okay, but actually doesn't really get people invested or excited about. Do you see that translating into your platform, that the lens through which people invest just needs a bit of a boost?
Well, I think that one of the things that we offer by being a U.S. platform and giving access to U.S. stocks is that diversification. So even if the UK IPO market or the UK markets have ups and downs, the U.S. markets are available for customers. So having more options and lower cost options that are easy to use, I think is needed here and really is good for the consumer.
But is there more of an appetite towards fixed income products because of an appetite for risk? And do you see that changing?
Fixed income products are interesting. So with the retail audience, we found that keeping it as simple as possible and really meeting the customer's core need, which is, in the case of fixed income, lower risk yield. And so we have a great product called Cash Sweep, where we can allow our customers, even when they're not investing in equities, to earn a yield on dollars on the platform. Right now it's 4.5% with up to $2.5 million of FDIC protection. So it's been a very popular product. And if you want to diversify into holding US dollars as a UK customer, I think it's the best value proposition on the market and very easy to use through Robinhood.
Yeah, of course we don't give investment advice, but it's a good pitch. Vlad, when you look at some of the interest rates, I mean, you've been able to hold on to a lot of deposits because you offer higher returns than some of your competitors. As the interest rates go down, what does that proposition look like?
Yeah, it's interesting. When, no pun intended, when Robinhood first went public in 2021, there was talk of Robinhood being sort of like a zero interest rate business. We'd done so well when rates were low because we had brought so many people into the markets to start investing in trading. The question was, how would we do if interest rates went up and kind of the tailwinds for the markets decreased? Because as you know, interest rates going up is kind of inversely correlated with stock market activity. But it took a lot of hard work. We had to essentially refound the business, mobilize towards retirement products, toward high yield. We launched a credit card in the US, and we built the business up to a point where net interest income actually surpassed transaction volume as our leading source of revenue. So our approach is we're going to continue to roll out new products. Many of our products actually will do better in a lower interest rate environment. For example, margin, which is coming in the UK, as well as options trading, more of our active trading products. Interest on cash becomes less attractive, but I think overall the business and the value proposition for customers should benefit even more from a lower interest rate environment.
Talk to me a little bit about, what happens after the UK. Are there any more international frays that you want to get into?
Yeah, so we're live in the European Union as well with our crypto offering, and we have a large crypto business as well. And really the focus in these two markets, UK and EU, is rounding out the product suite. So in the UK, people want more active trading products. There's some demand for crypto as well. And in the EU, customers want to invest in stocks. So we're going to round those out. And of course, in parallel, we're looking to expand to other markets. The long-term vision is every retail customer worldwide should have access to Robinhood and should get the lowest cost and easiest to use access to financial services possible through our platform.
But Vlad, I mean, Europe's crypto regulation, is kicking in at the end of the year. So how does that change some of your offerings or some of the products?
That's one of the reasons we wanted to enter the market, because Europe does provide clear rules of the road. They regulate things like initial coin offerings, staking. There's sort of like clear paths to offering some of these crypto services. And this is one area where Europe's actually in some ways ahead of the US in regulation. And, as an American and a European, I have mixed feelings about this. They're sort of behind in AI, somewhat ahead in financial services. But that's one of the reasons why we're excited about entering that market.
Are there any countries in Europe where you're looking for a full MiCA license?
We are looking to get that when it goes into effect. Yes, certainly.
Where in all the countries where you're in at the moment, or are there specific countries that you want to target?
We're licensed in Lithuania currently, but we might also get specific licensure in different markets depending on the particular local laws and regulations.
I have 1,000,001 questions, but let's talk a little bit about the U.S. You face competition from Schwab, Interactive Brokers on the retail brokerage space. How do you see that evolving in the next 12 to 18 months?
Yeah, I think that if you look back at the last 3 quarters we've reported, we've seen net inflows from all of our major competitors. So customers have been bringing assets to Robinhood from Schwab and from the others because there's been consolidation. As you probably know, Schwab acquired TD Ameritrade, which was a large active trader platform. Morgan Stanley acquired E-Trade. And so a lot of these customers are being force migrated to unknown platforms. And that forces them to kind of take a look at what else is out there. And a lot of them see Robinhood, they see the compelling pricing, the user experience. And this has been sort of like a extra nudge for them to move their assets over. And we've been doubling down on that, adding more products, more account types in the US. We have our first active trader event where I'm going to announce some new exciting products. That's in a couple of weeks in Miami. And so we've really been accelerating and trying to make it even easier and more compelling for customers to move all of their investment activities to us.
I mean, is there a danger? Can you give us a little bit of an idea of what the announcement will be? And is there a danger that you're going broad maybe too quickly, or is that really the aim because you want to get a little bit of market share? Like, do you have an ideal customer in mind?
Well, we have several types of customers, but the kind of core of our business is the active trader. Right. And the number one priority that we have as a business is to actually be the leader in the active trader market. If you look through 2023, we grew our market share in options by just under 20%. Equities grew by 14%. So we're on a path to that. And certainly there's ways to accelerate. Like, we're great on mobile, but our web product has some room for improvement. Up until recently, we weren't that competitive on margin, but now we have the leading rates in the industry. So there is a focus on active traders, but we don't want to just be an active trader business. We see much more potential for serving the mass market for that. And so we built compelling retirement products, which we hope to bring to the UK soon as well. The cash yield product, the credit card. I think that the more breadth of products we offer, the more compelling it is for a customer to bring their entire financial life into Robinhood.
So in the UK, is Revolut your biggest competitor?
I think there's a number of small startups. But I think the interesting thing about the UK is, unlike the US, there hasn't really been a zero commission revolution. You know, if you're a customer of one of the big brokers like Hargreaves, you're still paying, £10 a trade. And I think the incumbents here still have the majority of the market share. And so, there are some fintechs that have launched compelling products, but the market itself hasn't transformed in the way that Robinhood has transformed the market in the US. And since we launched in the US, individual household investment in equities has gone up something like 27%. In that time period in the UK, it's been basically flat. So we're hoping to change that here.
Talk to me a little bit about your other venture, Harmonic. How does that fit in? I mean, you raise money with it. How does that fit into the Robinhood ecosystem?
Completely separate company.
So it doesn't feed in at all?
No, Harmonic is an AI business. Yeah. We're building what we call mathematical superintelligence. And the idea is that, the current large language models that are out there are particularly good at, writing history essays, but we see gaps in their ability to produce verified output that is trusted. They hallucinate, they confidently state wrong things. And we want to solve this with mathematics by kind of imbuing mathematics as a primitive. And the side effect is the models that we build could then be used to solve really high stakes quantitative problems where accuracy is actually very critical. I mean, and that could be applied to financial services.
I was going to ask, the application could actually be in super algorithms.
Yeah,
right?
Financial services is obviously a big application of that, but so is aerospace, automotive, anything where the consequences of writing software with bugs and fundamental errors can be grave. So, I think the current models in AI don't adequately solve this problem, and there's like a convergence of forces that make now the right time to kind of build this technology.
Vlad, thank you so much for joining us today. We went around the world looking at all of the things that you're trying to solve. Vlad Tenev there, the chief executive of Robinhood. Now, coming up, EU member states vote on whether to impose tariffs on Chinese electric vehicles. So which way will the vote go? We'll be discussing that next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, the EU is voting on tougher tariffs on Chinese EV imports, with Germany reportedly indicating that it will vote against them. Now, with us now is Bloomberg's global automotive editor, Craig Trudell. I'm much preferring you a card czar, but we're also joined from Hong Kong by our Asia transport reporter, Linda Liu. So thank you both for joining us. Craig, I mean, which way will it go? As always, member states of the EU don't always vote in the same way.
Yeah, that's right. And I think it would be surprising if we do see these tariffs go ahead and Germany be on the sort of losing side of this. We wouldn't necessarily expect that. I think it would be somewhat of a rarity and kind of remarkable, right, in the sense that Germany's automakers are really unified in opposing these tariffs and have come out very loudly saying so.
When you look, Linda, at some of, if these are passed, what are some of the measures that could, I guess, trigger retaliatory duties from China?
So Beijing has hinted that it's not beyond taking retaliatory measures. It's already launched anti-dumping investigations into pork, which could affect Spain, as well as brandy, which can affect France. It's also hinted that it could take action against large engine cars imported into China, as well as dairy. So how Beijing responds is very much dependent on how this EU EV tariffs votes will go. So I think some of these companies in the EU would be maybe lobbying their governments to vote in a way that can protect their interests as well.
Yeah, and Craig, Germany was really quite careful. We also spoke to one of the chief economic advisors, and then we heard from Robert Habeck, the economy minister. I mean, they were floating the idea that actually China could self-regulate, or at least say, like, look, we're going to export, but we'll cut down on the subsidies. Is this something that's being talked about?
Yeah, I think it is being talked about, and I've found it very interesting that, you know, just in the lead up to this, we've seen the Chinese companies not necessarily priced so aggressively in Europe. It was almost as though they were trying to avoid this by not undercutting, you know, pricing. They weren't necessarily coming in with, you know, 5,000 or 10,000 euro difference in segment. It was as though they were trying to, you know, take pricing here that they can't, you know, can't pull off in China because of just how competitive the market is there. And even despite that restraint that they showed, they were able to gain some traction, and it did set off alarm bells in Brussels.
So, Linda, again, I guess the two sides are still exploring these ideas, which I have to say are pretty complex, or mechanisms to kind of control prices and volume of exports. Is that something that China, on the Chinese side, they're taking very seriously, Linda?
Yes, so Chinese trade bodies, as well as the Chinese Minister of Commerce, have visited Europe, as well as sending proposals by making price guarantees, you know, selling no below a price threshold, as well as controlling export volumes. So we heard that some of these proposals have been put forward to the EU. It's not unclear how much the EU will accept this, given, you know, the entire auto industry, as well as the thousands of jobs that are on the line domestically. You've also got talks of Chinese companies looking to localize production in Europe to get around the tariffs. Now, I think that would be a welcome move for the region. But again, I think China is delaying making big decisions pending on how this vote will turn out.
Yeah, and Craig, again, if there's an escalation, is it again the German car makers that get slammed, like Volkswagen and BMW?
Yeah, I think Linda mentioned earlier the retaliatory threat of cars with large engines that would hit the German car makers hard, but it would also hit, you know, some companies that, you know, don't necessarily sell in big volumes, but China would makes for a significant share of their volumes. Think, you know, companies like Ferrari or brands like Porsche. These are, you know, manufacturers that don't necessarily sell in huge volumes, but it's a significant share of their business. They too are concerned about this as well.
Thank you both for joining us. Bloomberg's Craig Trudell there and Linda Liu. Now, coming up, we take a look at FX as bets shift on BOE and BOJ rate paths. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
next?
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back, everyone. Pound gaining slightly this morning as BOE chief economist Hugh Pill called for gradual cuts in a speech. Now, sterling saw its worst day against the euro in almost 2 years this week as Governor Andrew Bailey suggested the BOE could take a more aggressive approach to lowering rates. Well, joining us now for more is Rachel Evans, Bloomberg's managing editor for FX and rates for EMEA and the U.S. Rachel, always great speech, especially on these big market moves. Andrew Bailey yesterday kind of really moved the markets. And so I don't know whether the message from Hugh Pill today is like, wait, hold on, or whether he's just always more on the hawkish side.
Yes, I mean, there probably is an aspect of the BOE trying to balance things. I think yesterday's moves did seem to extend maybe a little bit further than maybe Bailey had anticipated in those comments, which were relatively anodyne. You know, we're talking about more aggressive cuts possibly being necessary, but the market is so sensitive to any sign that the BOE is going to have to cut faster. We have an awful lot of people betting on more pound strength at the moment, so there really is that kind of propensity to, if you see something that undermines that position, to get out and then ask questions later. So there may have been a sense to which Pill was kind of trying to moderate those comments a little, put a little bit of a kind of ballast under the pound, but he has been more hawkish of late. So we did see, for example, in August when the Bank of England did cut interest rates, that Pill was one of those actually voting to hold interest rates at that point. So I think there is also a little bit of this is kind of Hugh Pill expressing his stance, his position within the Bank of England Monetary Policy Committee.
What's your take on yen? I mean, again, a lot going on. We have an election October 27th. We're just getting to know this possible new prime minister as well.
Yeah, and I think the market is as well. It felt like, you know, earlier this week, maybe he'd kind of gone a little bit further than perhaps he thought he'd gone in sort of talking about, you know, the Bank of Japan being in no rush to kind of hike rates. He came out today and there was a bit more kind of colour around that, saying that, you know, he and Ueda, the Bank of Japan governor, are very aligned in terms of policy. So trying to put a little bit more clarity around those remarks. But certainly, I mean, this was something that really did move the yen. We saw more than kind of a 2% sort of weakening in the currency on, I think it was Wednesday this week. So, I mean, I think it shows you just how sensitive the market really is to just the political and the monetary policy decisions within Japan, given that we have had so much scrutiny of that dollar-yen exchange rate. You know, obviously, the authorities there really want to see a stronger yen, and anything that kind of like puts that case back and weakens the yen is not going to be something that does them any favours. It actually makes the possibility of a bigger hike more likely.
Rachel, thank you so much for the terrific briefing. Rachel Evans there with the very latest on some of the big FX moves. Up next, Bloomberg Brief, Manus Cranny in New York, and this is Bloomberg.
about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Granny. You're welcome to Bloomberg Brief. Let's set your agenda. Health check in the USA as the bond bulls retreat. Non-farm payrolls expected to add 150,000 jobs. Tensions rise in the Middle East, weighing on stocks as crude tracks for the biggest weekly gain since early 2023. And reopen the ports. Dock workers call time on the strike, delivering a 62% pay deal. A little bit of breaking news for you now coming through from the EU. We will come back to that in just a moment. There are tariffs coming down the pike on electric vehicles for China. Right now, this is where we are. We're steadying our nerves. We're on track for the first weekly loss in over 4 weeks. Let's just give you that breaking news. This is what we've got. The EU votes to impose tariffs of up to 45% on China-made electric vehicles. Of course, the risk here is retaliatory action from the Chinese. The vote comes as the European Commission determined that China unfairly subsidized their electric vehicle industry, and they proposed the tariffs to protect the European car companies. We'll have more on that story through the morning. Let me just show you what is going on in the markets. As I say, a little bit nervous. One could say that the bulls are nervous both in the stock market and indeed in the bond market. The whisper number at the moment is 152,000. Bank of America say if you get anywhere between 125 and 175, it is a soft landing. Roll it over, have a look at the bond market. We've backed up this week on the 10s, up 6 basis points yesterday. Services numbers here in the United States of America, the fastest pace of growth since 2023. Yields tick down ever so slightly. Going into this jobs report, by the way, you are the least bullish on this market, according to BMO, since January 2025. And just the backdrop to this 24 hours is services are strong. You are looking at the last 2 jobs reports. We saw equities drop by over 1.7%. So brace, brace, brace. Let's see what happens today. Economists are anticipating it's been described as a stable growth for today's jobs report. 8:30 a.m. Eastern will bring you all the details on surveillance. Jeff Yu is my guest this morning, senior strategist for EMEA markets at BNY Mellon. Jeff, good morning to you. We're looking at a progressive slowdown in the United States in the jobs market. So it's not a Wile E. Coyote moment. It's not some precipitous drop. That's the base case thinking. What does that mean for the landing?
Yeah. Well, you say that's the base case thinking, but given all of the jobs reports here from JOLT to ADP, maybe not the Challenger survey, but I guess there are those in the market to think about a tail risk of not exactly re-acceleration, but what if we just don't, quote unquote, land further from here, right? So I think, that's sort of just a short-term tactical element we need to think about. But the bottom line is for those exigent positions looking for another 50 from the Fed or anything like that, I think they need to just re-explore them very, very carefully. That's looking like a long shot right now.
Well, this comes back to the concept. Adam Posen was with us yesterday. He said, just because you take out an insurance policy, like a jumbo rate kind of 50 basis points, do not assume that they will buy that again. And that's where you come down, is it?
Absolutely, and if you think about what the Fed's been trying to communicate, there's no sense of panic. Even with the 50 itself, it was a bit of what I would call a down payment for insurance. Not even outright insurance. So just making sure that they tell the market they've got their hands at the steering wheel, making sure they know what is going on. But it's going to be data dependency at the end of the day. Whereby if we look at what's going on in Europe and the ECB, they're looking at the risk of current data outturns deviating from their baseline forecast to the downside, hence a bit of a change in tune of late, and whereby the Fed doesn't really need to do anything at this point. It's a bit like autopiloting.
Well, if we're autopiloting at the moment, the risk is that the tail risk fattens up, and that is the unemployment rate. Given historical data and trends, but looking at the current state of this U.S. economy, it doesn't seem that that unemployment rate is in danger zone anytime soon.
I don't think so, and that would be conducive to the Fed's outlook. And of course, they will say if we get a sudden surge and things along those lines, then they will be in a position to change their minds. I think communication has been very, very consistent, right? So we can head into November and the December decisions and see if there are any revisions to that. Of course, I think the market does have one eye on the current surprises in both directions to the data, but also with on other things in geopolitics as well.
Tell me this then, Jeff, on the dollar, if you have a soft landing, no landing is where you are. Does that underpin U.S. exceptionalism and then quid pro quo with the dollar?
It does, and to be frank, even with the Fed's communication in September, I think U.S. exceptionalism was in place. It's just a question of, from a scale of 1 to 10, your overweights in the U.S., you were probably at 13, and now you can bring it down to 9, right, so to speak. All right, and that, in hindsight, is where, looking at my euro-dollar call for the year, I just underestimated the degree of U.S. exceptionalism positions, which are on a potential for them to be unwound. But now at this point, you look at dollar-yen, I think with the exception of dollar EM APAC right now, people are still happy owning dollars. Slight increase in the carry trade again, but it doesn't mean the dollar can't be on the right side of that either.
Indeed, and geopolitics also adds into the baseline for holding dollars, perhaps relative to the others. I want to get to the port workers. They've called off the strike. They have a 62% pay rise over 6 years. I look at Boeing, they're putting 30% on the table. How do you look at the wage narrative, the negotiating wage cycle going forward from here? Does this create stickier inflation, wage inflation?
Yes, and I think all central banks are communicating, that right now. Equilibrium, rates, neutral rates, and also long-term unemployment rates, that could actually be lower than expectations, and this is something really, really difficult for central banks to calibrate when it comes to supply issues and labor supply issues. So they have to look at this very, very carefully, and especially with the ports, right, that had the potential to have knock-on effects into other areas of the economy as well. But look at the UK, public sector, wage increases. Is that going to be a focus for the upcoming budget as well? And I think this would underpin the comments we've just had from Hugh Pill, just saying, hold on a second, let's not be too hasty and cutting very aggressively. You don't know where the wage outlook right now is.
Well, there's a classic between Bailey and Hugh Pill, isn't it? I mean, mind the gap and the damage that you do to sterling. Always good to get your view on what's happening in Japan. Lots of headlines. The carry trade's reignited. Ishiba You know, he's knocked the yen off by 3% this week. The economy isn't ready for further interest rate hikes, and then sort of backtracks. This is interventionism in a different way.
Indeed, and I feel like we're just getting a few too many headlines, from Japan and not from the BOJ, if you know what I mean. So, that's one aspect to look at. But I think with the yen carry trade, notwithstanding that episode we had in August, when there was a lot of unwinding, cleared out a lot of positions. If it ain't broke, don't fix it. But if I look at our custodial data right now, tracking the flows, what's interesting is the yen is still underheld. So let's be clear, people owning the yen-funded carry trade, but not so much as dollars. It's actually the likes of long EM currencies against the yen, Mexican peso, for example, Brazilian real, those positions, euro yen, Aussie yen even, I think that is actually forming the crux of the yen carry trade right now, and they may just suffer a bit of a wobble on the other side. But dollar yen right now, it just feels like people are comfortable, owning it as long as they want to hold on to that US exceptionism, especially for the next 2 or 3 weeks or so.
Well, look, it is pervasive, isn't it, with geopolitics, and of course an election which is upcoming 30 days out. Jeff, thank you so much. Jeff Yu from BNY Mellon. Other stories trending on your Bloomberg terminal this Friday morning. Spirit Airlines is struggling to reach a rescue deal with its bondholders, and the time is running short. The air carrier is seeking new financing from its creditors and an extension to the current debt, or it risks being forced into bankruptcy. That's according to Bloomberg sources. Cisco has agreed to invest in one of the hottest young companies in AI. CoreWeave is a client computing provider that got the edge in the market by adopting NVIDIA GPUs in its data centers. The startup is close to reaching a deal with Cisco, which could value the company at $23 billion. Seven & i has approached potential buyers for multiple businesses within the supermarket empire. The Japanese retailer is looking to restructure as it faces a takeover approach from Canada's Couche-Tard. The 7-Eleven owner faces pressure to show it can command a higher valuation and rejects a preliminary approach for being insufficient. Well, coming up, the U.S. dock workers, they head back to the ports as the talks continue. What is on the slate?
The dock workers are going back to work, and the next 90 days we're going to settle everything.
And later this hour, we'll count you down to the payrolls report. City's Veronica Clark joins me around the desk with Mike McKee. Economics is first on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's Jobs Day, and Bloomberg has the report under surveillance.
Markets pay attention to one thing at a time.
It's all about that wage data.
Wages are stabilizing, and that's good news for the inflation story.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Are we losing dynamism in this labor market?
We don't have a jobs problem at the moment.
It all comes down to what the data says.
How important is that payroll data going to be?
The September Jobs Report, today on Bloomberg.
The strike is over.
Yes, the strike's over. We got a call from our international. We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months and other issues that we need resolved.
That was the ILA Local 333 President Scott Cowan speaking as soon as the U.S. dock workers agreed to suspend the 3-day strike. Now, the union and the employers will restart negotiations on the longer-term contract. What exactly does that mean? Brendan Murray is with me. Brendan, this was resolved pretty darn quickly, but when I look at the language from the ILA President Daggett, he says, we want absolute airtight language, no automation or semi-automation. So there's a wide gap here between the pay deal and real resolution.
Yeah, absolutely. I mean, I think we can chalk this up as a small win for three different stakeholders here. The dock workers get their pay increase, 61.5%. You heard one of them say the shipping lines get to resume, the global trade, exports and imports without a ton of disruption, and the White House gets a reprieve from an economic situation that was quickly going downhill. Another week or so, and we would have seen shortages of food and other kinds of things on grocery shelves, and that could have set off, some panic buying. So all three basically walk away with a little more time to work this out. Definitely the key issue of automation is one that they've been talking about for years, let alone the past couple months during these contract talks. So automation is not an easy situation. The shipping lines, the port operators want to make their operations more efficient. The dock workers say that's our livelihood. We're going to stand firm on that. So definitely a win for several parties, but still some tough talks ahead.
Look, this is going to be political relief for the White House, obviously Biden known as Union Joe, but for Harris this is also critically important because she's slightly behind relative to her other former peers when it comes to support from the union. So this is a sigh of relief for her, isn't it?
Oh, definitely. I mean, I think there's a sense that this situation, if it lasted much longer, could really cause a problem. That the incumbent, White House, Joe Biden and by association, Kamala Harris, couldn't find a resolution, couldn't deal with this situation in a way that prevented the shock to the economy, the shock to consumers. So definitely, a sigh of relief this morning. The ports are reopening. That may take 12 hours, 24 hours. A lot of them are going to be open this weekend to deal with the backlog. So, there's 40 ships out there. That will take about a week to work through.
Brendan, thank you so much. Bloomberg's Brendan Murray on the port strike coming to a close. In the Middle East, the Iranian Supreme Leader speaking earlier at prayers in Tehran saying, quote, "We will strike again if necessary." Now, this as the attacks in the region continue, with Israel bombing more than a dozen Hezbollah targets in Beirut. Hezbollah also claiming that it fired rockets at Israeli army positions. Meanwhile, the G7, the nations there, releasing a statement calling for restraint, writing, quote, "A dangerous cycle of attacks and retaliation risks, fueling uncontrollable escalation in the Middle East, which is in no one's interest." Paul Wallace is with me now. Paul, when you read that story from the G7, we are incrementally every day getting closer to some kind of break point, and that is the worst case scenario, which is hitting Iran in some of these strategic positions on oil or indeed their nuclear facilities. But oil is squarely in focus this week.
Hi, Manus. It definitely is, especially after Joe Biden's comments yesterday when he said that there were discussions around Israel hitting Iranian oil facilities, which immediately sent Brent crude soaring. So oil is certainly in focus. It's unclear whether Israel has actually decided what it wants to do, and it's just waiting for what it feels is the best moment. There's a lot of feeling that it would react quite quickly within a matter of days to Tuesday's missile barrage from Iran. So there's certainly a strong feeling that we could get something, the answer to what Israel will do, over this weekend.
Here's the thing, Paul, we're up 8% on the week. Lots of analyst notes coming out about the potential impact of taking out Iranian export facilities, which is just under 2 million barrels. We're juxtaposed between the surplus and the potential loss from Iran. How do people look at this market? It's tightening up, isn't it?
It is tightening up. And I think for some people, if, let's say, and this would, I think, be an extreme scenario, but let's just say Iran's exports were completely taken off the market. The global oil market could probably cope with that. Other members of OPEC have enough spare capacity and then some to sort of make up for all Iran's exports coming off the global market. But you've got to factor in what Iran's reaction will be in that situation. And Iran has been implying that it will retaliate very aggressively against any kind of strike on its territory, not just against Israel, but against any country it thinks is aiding Israel with those strikes. And in that situation, if Israel does go after, its oil export facilities, I don't think you can say that, Saudi facilities, UAE facilities, and those of other countries in the Gulf are completely off the cards. They may not be, and I think this is what the G7 is implying when it talks about, a spiral, an uncontrolled spiral in regional tensions. We get these tit-for-tat attacks, but they're pretty major ones. And
would a spiral, Paul, if we're to consider what a spiral out of control looks like, it squarely comes to the geography nearward to your sitting, which is the Strait of Hormuz. And of course, it's been a long time since the Houthis attacked infrastructure in Saudi Arabia. We're a long way away from what that was a number of years ago. But that's squarely what we're talking about here, which is heightened risk in the Strait of Hormuz.
Exactly. That is militarily, that's pretty much the easiest thing for Iran to do if things get that bad. It's much easier for Iran to hit out at tankers and facilities in the UAE and Saudi Arabia and elsewhere in the Gulf than it is to hit Israel. Israel is very far away. Israel has got very sophisticated air defenses and all that. It's much easier. And Iran could say, well, if we get into a situation where Israel is hitting our oil facilities or our nuclear facilities or whatever, they may say, well, then we will attack other countries' assets because that's leverage we can use to put pressure on Israel to back down. And that's the kind of scenario that I think really worries world powers.
Indeed. Paul, thank you very much. Paul Wallace with the very latest from the Middle East. As we've been saying, oil is tracking higher, 5% higher yesterday on that language from Joe Biden. The U.S. is discussing Israel attacks on oil facilities. That infected a massive spike in the price of oil, up 5% on the day, 8% on the week. This is Brent this morning, adding another 1%. We are talking about the risk of Israel striking Iranian oil facilities. ANZ say that is the least likely because of the ferocity of the response. Gold is up again this morning ahead of this jobs report. It is jobs day in the USA. Of course, we've just come off a record high in late September. Coming up in the show, we look at what else is moving the headlines around the world, including the former president's plans to blitz the campaign trail right here on Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Early mail-in voting is underway now in Michigan, so if you want, go out and get that ballot, return it as soon as possible. And if not, get a ballot, just go and vote. You got to vote. We got to win this election.
Get out and vote. That was the former President Donald Trump telling his voters in Michigan, begin to get out the vote. Look at the front pages from around the world. And a picture of the campaign trail for this weekend for you. First up, Reuters. Musk will attend the Trump rally in Pennsylvania. That was the site, of course, of the assassination. The former president returns to Butler on Saturday, and it's a bit to recapture momentum, some are saying, 31 days before the election. Washington Post leads with Liz Cheney rallying with Harris, imploring the nation to reject depraved cruelty. Trump, the former Republican Congresswoman, joined the Democratic nominee in Ripon, Wisconsin, which is also known as the birthplace of the GOP. The vice president heads to Flint in Michigan for a rally later today. So they were both hunkering down in Michigan yesterday. And Bloomberg goes with Obama, launching a 4-week campaign blitz on behalf of Harris. The former president will spend the run in trying to sway the swing voters to vote for his Democratic successor. A little bit of breaking news coming through for you from Israel. They're conducting limited, localized raids in the south of Lebanon. Israel says they are eliminating Hezbollah militants at close range.
I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manus Cranny. Let's set your agenda. It's health check day for the USA as the bond bulls retreat. Non-farm payrolls are expected to add 150,000 jobs. Tensions rise in the Middle East, weighing on stocks. This as crude tracks its biggest weekly gain since early 2023. And reopen the ports. Dock workers called time on the strike, delivering a 62% pay deal. We're a little bit nervous. We're counting down to non-farm payrolls. 150,000 is the number that we are expecting. The whisper number is a little bit higher, 152,000. Stocks are steadying their nerves. You've got services in this country at a 19-month high, but brace for a bit of volatility. The last two jobs reports saw stocks drop by 1.7%. If you get 125 to 175, Bank of America says you've got a soft landing. A blowout report, well, that could spark a little bit of a sell-off and a jump in yields. Roll it over, have a look at those bond markets, because I can tell you what, the bond bulls are in retreat pretty much on the back of the services number, the oil spike. BMO have done their survey, 34%. See, the next 15 basis points as the next 15 basis points is lower. That's quite small. It's the least bullish since January 2025. We've had these yields back up through the week. We are 3 hours away from the latest jobs report. Mike McKee joins me around the desk. Mike, good to see you. Look, 150,000, 152 on the whisper, but it's the overall trajectory. It's about a progressive slowing. That's the consensus at the moment on the jobs report?
That's the overall concern. Are we slowing too fast? The economy has been producing jobs at a very, very high pace for a long time. We've started to see a slowdown now, and that has started to get people concerned about, did the Fed get behind the curve? And so we're seeing a lot of people who are coming in low. We've got 70,000 for the low forecast for the month, but we've still got a lot of people who can't get over the fact that the economy keeps surprising us, and I think the high forecast is for 220,000 right now. But as you mentioned, we have seen a slowing in the pace of job creation over the last 12 to 6 to 3 months. Mm-hmm. Each time has gotten slower. And so the question is, does that trend continue or does it level off? And that's what people are going to be looking at. Now, the real number, though, that Wall Street's going to be looking at is the unemployment rate, yes, which is forecast to stay at 4.2%, because that's the number that the Fed has emphasized. And the Fed says we're going to get to 4.4% by the end of the year. Are we?
Well, the question
Tune in at 8:30.
Yeah, I mean, look, the unemployment rate is the one that Powell has very squarely put his money down on. What you're hearing is that a low estimate of 4.4% for the end of the year? Because we've shifted by over 1% in the past 12 months, haven't we?
Well, the Fed has actually moved up to 4.4%.
Incrementally, yes.
They've been up and down as the year has gone on, because it's been a very hard year to forecast. But now they're at 4.4%, which is would tell you that if we got to 4.4%, maybe over a couple of months, then they're going to stick with the 25 basis point cut pace that they're doing. If we get to there in one jump, or if it continues then to go above that, then we might see them speed things up.
It was interesting on the ADP numbers, yes. I mean, the tagline on this jobs report is expected to be, you know, slow of hiring, but no major firing. But the ADP was a stronger number, but it didn't come with hotter wages.
No, that has slowed, and that's helped the Fed out a lot. You've heard Jay Powell say that they don't think that the labor market and wages are going to cause inflation anymore. Now, you have some people who are still worried about that, Mickey Bowman, for one, the Fed governor. But at this point, they're not really looking at the inflation component of this, which is why at the top I didn't mention the average hourly earnings, which are supposed to tick down just a little bit.
So you're off to speak to Mr. Goolsbee. What's going to, I mean, you'll have the data at that stage. So thematically, you know, he says rates need to fall a lot. So what's your top thought for him?
Well, we'll see what the numbers show, and does that ratify his belief, his call, or does he have to rethink it? And what would cause him to rethink it at this point? And
recalibrate, Mike, recalibrate.
Recalibrate, yes, we have to use the proper word. I don't know, transitory was a better word than recalibrate. It was easier to say.
Transitory over recalibration. There you go. Mike McKee. We'll break the numbers down, of course, and you can catch Mike's interview with the Chicago Fed President, Austin Goolsbee. That's at 10 a.m. Post the jobs numbers. We'll break the jobs numbers down for you in surveillance. The whole team will be there. Well, the Wells Fargo chief economist, Jay Bryson, weighs in on what a softer jobs print would mean for the Fed.
A year ago, all the weight was on CPI. Nobody really cared much about the labor market. We've transitioned, and, you know, as we just said, Jackson Hole's speech, Powell was saying, we don't welcome any further weakening in the labor market. So if you do get a weak print on non-farm payrolls, if you do get the unemployment rate ticking up, another 50 basis point rate cut in November is definitely in play.
Veronica Clark is the U.S. economist for Citi. If you want a weakening in the jobs market, this is the lady to give it to you. Veronica, you're in at 70,000 for non-farm payrolls. Just run me through your thinking on why we touched that level, because that's low end of consensus.
It is the low. I think if we look at the whole of this year, all the labor market data that we've seen this year, you know, there was this clearer trend in slowing even at the beginning of the year, hiring pulling back, of course, you know, well summarized by the unemployment rate increasing. But back, you know, 4 or 5 months ago, payrolls were very consistently strong. They looked like the outlier in a sense. But we have had a slowing now in the last 3 or 4 months. And it feels to me like payrolls is just joining the rest of the data and showing this weakening trend. And I think that trend will continue this morning. If it's not today, it's within the next couple months. It just feels like a labor market that's weakening.
So sub 100 or even at 70, which is where your call is, I mean, that is going to light a torch under the rates market in terms of calling for another 50 basis points, which a lot of people have said was an expensive insurance cut.
Yeah, I think it would be surprising if we saw 70K today. Of course, we also have the unemployment rate rising, and that does maybe matter a bit more for the Fed, have that going back to 4.3. And yeah, I think this is a Fed that is cutting 50 basis points again in November. In a sense, yes, the 50 basis points September was making up for some lost time, but every Fed official is going to think that they're very far from where the neutral rate is at this point. And you don't want to be at neutral a year from now. You want to be there as soon as you can.
And it's the single most, I think to quote Powell, it's the single most important one probably. This committee is not in a hurry. So you say the data will force his hand to move him from a light jog to a faster run.
Essentially, yeah. I mean, if you listen to Fed speak about how they're talking about their forecasts over the last 6 months or so, we got this sense, of course, in June when we had that SEP update in June. They are really, not necessarily forecasting where we think the data are going. And yes, if the data evolve in line with their soft landing kind of forecast, they'll go slower. But I think we're always basing our forecasts on the data first and how the Fed will react to that data.
I mean, we had Jeff, he's in the no landing camp. You've got Larry Fink in the no landing camp. You've got Mark Rowan this week talking about an expensive insurance cut. You're a little bit more bearish.
Yeah, it comes down to the labor market. I mean, we definitely have had some strong activity data. Spending, we had some of those big GDP revisions higher. So the activity side of things is holding up. But I would think that if people are starting to lose their jobs, the unemployment rate is rising more sharply, that's what's going to matter more for future spending. People would cut back on spending in that case. So I do think it really just comes down to the labor market.
when we look at this political campaign, there's different promises on tax from various sides. You've got Trump, obviously, on corporate tax cuts and giveaways. You've got Harris wanting to raise the corporation tax. But when you look at the policies on debt to GDP, that's expected to rise a little bit more dramatically under Trump, up at 116, versus Harris. From a fiscal point of view, going into 2025, how expansionary will 2025 be, regardless of who comes in?
Yeah, so for 2025, I mean, most of the policies that we would expect from the election really aren't going to impact things until maybe 2026. We're not going to get,
Do we get the juice in 2026, the foundation in 25, the juice in 26?
Yeah, you wouldn't really see most of these policies implemented impacting the economy, I think, until 2026. So for 2025, deficits are still wide. I do think that's a reasonable conclusion, regardless of the election outcome, that deficits do stay pretty wide. But we've actually had, we're coming off of a year or two of pretty substantial fiscal spending, and deficits are still wide for this year, but they're essentially flat. That growth impulse has maybe already happened. But yes, deficits staying wide, I think, is a reasonable conclusion.
Yeah, just the corollary to the conversation that we've had is that the 4.4% assumption by the Federal Reserve in terms of the unemployment rate, is that low?
I think that's a little low,
Okay.
just in the sense that, in past labor market cycles, and the unemployment rate really does look like it, now that it does in past cycles, it rises very gradually, and then you start to see that acceleration, and I think we've seen that over the summer. And at some point, you reach this nonlinearity, and it can rise much faster. That's essentially the pattern that we're thinking plays out this time also.
So you're not a buyer of this stickier, higher inflation U-turn from the Fed next year?
I can see inflation concerns coming back for sure, maybe within the next couple of years. But it does seem like in a weakening labor market, demand is going to be soft enough, and consumers are already pushing back on spending on higher prices. I do think you'll get that slowing in inflation.
The consumer is all important here. I looked at some of the data from Ed Yardeni put out the revisions. Personal income revised to 3.3%, a massive upward revision there. Personal saving, $1.1 trillion, way over what we had earlier in the year. So all the call about the demise of the consumer is perhaps a little bit overdone. I know it's bifurcated, and I know a lot of this income comes from land, and comes from rent, it comes from perhaps middle class and upper middle class things. But this economy and this consumer remains resilient.
Yeah, those big upward income revisions were a bit surprising, essentially because they're also based on that QCW data, which is telling us that employment was even less than we thought. So those were a bit surprising. It does seem like the consumer is coming from a bit healthier place, but what's going to determine marginal spending is, I think, if you have a job going forward. The biggest component of income still is labor income, and if payrolls are slowing, that will be slowing, and I think people would be cutting back on spending then.
And the refinancing in mortgages, I mean, we're seeing 30-year mortgages dip. That's healthy, that's progressive for the housing market. Does that just tinker at the edges, really?
Yeah, we've seen, we have more weekly data on mortgage refinances, mortgage applications for purchases. Those refinances have come up a little bit, but most people are going to have a mortgage rate that's still much lower than where we are now.
I'm not getting you anywhere off the slightly bearish peg. Veronica, thank you so much for being with us this morning. We'll see what those payrolls numbers are a little bit later on at 8:30 a.m. The surveillance team will break those down in detail for you. Veronica Clark, our guest this morning from Citi. Coming up, the analysis, a little bit more for you. And this time, we're going to talk about Kamala Harris and Donald Trump and their plans for the economy. Context matters on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The strike is over.
Yes, strike's over. We got a call from our international. We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months and other issues that we need resolved.
That was the ILA Local 333 President Scott Cowan speaking as soon as the U.S. dock workers agreed to suspend the three-day strike. The union and the employers will restart negotiations on longer-term agreements. Brendan Murray has been tracking this story for us. Brendan, this resolved quite quickly. The question is, of course, this is the start of a much bigger renegotiation around automation, and the unions sound pretty aggressive about no jobs lost on automation. That's a hope rather than a probability.
Yeah, exactly. So the dock workers are going back to work today. The ships are going to start moving, and the White House is waking up with one less economic problem on its hands. The union got what they wanted in terms of wage increases in this new 6-year contract, almost 62% increase in total over that span. But the automation issue is one that they're going to have to really dig in their heels on, because ports all over the world are automating, and if the American longshoremen are going to hold back the tide of that, they're going to have a lot of work to do over the next 3.5 months.
Okay, Brendan, thank you very much. Will the docks reopen? The bananas will come for sure onto the eastern seaboard. There was a lot of concern over that. Brendan Murray tracking the dock workers' strike. It has been suspended, and the U.S. is still facing industrial action from the plane maker and the risk of losing jobs in the steel industry. But the future of its labor market depends on the presidential election, and that is 32 days away. Enda Karen joins us for our election brief. He covers the U.S. and global economy and joins us to analyze what the candidates are proposing. Look, today's jobs report, let's just square this away. There's a political potency to the next two jobs reports, Enda, isn't there? And for one thing, the port strike has been removed, and so they will be cleaner reports than perhaps we'd anticipated.
Yeah, it feels like we're at something of a turning point in the jobs market, Manus. Clearly, demand for labour is weaker. That's coming at a critical time just ahead of the elections. The manufacturing sector, for example, they're cutting jobs, and that resonates in the swing states. So obviously, a weak jobs number today will be fuel for the Trump campaign that the Biden-Harris administration aren't running the economy very well. Likewise, a good number would allow Vice President Harris to say they're pulling off a soft landing. So there is a lot of political capital coming out of the jobs data today.
Well, let's just dig a little bit more into Trump versus Harris. If we look at the Trump campaign, it's very much about lower taxes, the use of tariffs. You're looking at a corporation tax of around 15%, Harris at 28%. One is about intervention. One could say Harris is a little bit more interventionist relative to Trump. But I'm drawn to what Maya McGuinness says. This is an Oprah tax environment. You get a tax, break, you get a tax break. Let's start with Trump first of all, because the tax breaks he's talking about has significant impact on the debt to GDP and on the fiscal aspect for the US.
Yeah, no doubt, two very different economic visions being offered to the public. Very large gulf in the policy proposals. Like you mentioned, on the one side, former President Trump wants to bring down taxes writ large, bring down the corporate tax all the way to 15%, and of course raise tariffs on goods coming into the country. Now, he says that will generate investment, it will drive innovation, and it will prod more manufacturing to be based in the US. More manufacturing based in the US means more jobs. So again, that's a message to those swing states. But of course, the pushback, like you mentioned there, Manus, is economists say, hold on, there could be some inflationary aspects to that. And of course, they're questioning what would it mean for the fiscal deficit. Of course, it would mean the deficit needs to blow out. That's the cautionary side of the Trump proposal. But yes, quite different from what Harris is talking about.
Yeah, I mean, and we were talking about this. This is a debt to GDP ratio of 116% by 2028 under him, 109% under Harris. So the question then becomes under Harris. I mean, the accusation is from his camp is that this is an interventionist potential president. She wants to do tax deductions, but she wants to do tax deductions on childcare, on medical care, and of course on small businesses. So to that extent, Enda, how much of an impact on the deficit would she have relative to Trump and to growth?
So both are, neither candidate are preaching fiscal austerity, Manus, to be clear on that. But I think when it comes down to who would drive the deficit out the largest, the biggest gap still comes on former President Trump's side. As you mentioned, Vice President Harris is talking about raising the corporate tax rate. She says that will offset some of the revenue losses around her proposals around the childcare tax credit and tax breaks for small businesses. But the bigger fiscal hole is still on the Trump side of things. Economists have pointed this out. In particular, they question whether or not the projections for revenue to be raised by tariffs will be enough to fund the policies that he's talking about. And again, this just speaks to the idea of where there is a gulf between both candidates and a very different economic vision. Like I say, neither preaching fiscal austerity, but the bigger gap in terms of spending and revenue probably seen on the Trump side more than the Harris side.
Look, before we just touch on the immigration policy from Trump relative to Harris, on the tariffs, the risk is 20% tariffs on all imports. This is what has been touted, and 60% on China. There's a retaliatory risk on that, and that can be an inflation and a growth negative, can't it?
Exactly right, Manus. And again, economists will say, okay, on paper, those policies might stoke growth, they might stoke revenue and spur manufacturing to be set up here, but the trade-off and the cost is that it could also result in a higher cost of goods for consumers. And there are question marks over what revenue would ultimately come from tariffs. Anyway, revenue from tariffs tend to peak at the very beginning, and then it starts to decline because consumers change their spending patterns, manufacturing and production supply chains shuffle around. So there are a lot of variables at play when it comes to using tariffs as a principal source of revenue for these policies.
Let's just square off on immigration, because the Trump campaign and the policy has been about the biggest deportation on record. And then you look back at the security bill, the border security bill, which was thwarted a couple of times in the run-up to this election. How do you think, if he does get into power, the biggest deportation on record would be effected? How would it actually work, Enda?
So one of the most sensitive areas of the campaign has certainly been immigration. And as you mentioned, Manus, former President Trump probably has the starkest approach. He wants to push through, if elected, this mass deportation campaign, and the mechanics of that are not clear. A lot of companies and businesses will tell you that they have relied on the immigration surge over the past couple of years to fill positions that they otherwise could not have filled. Policymakers will say immigration played a role, of course, not just in ensuring the economy pulled off a soft landing, but in offsetting inflation. So if you were to bring a mass deportation campaign into the middle of that, lots of people are asking the questions around what are the mechanics of that? How does it work? How do companies go about declaring whether or not they have legal or illegal immigrants, the practicalities of enforcing it, and of course, which sectors will be hit hardest? You're talking about maybe hospitality, manufacturing, food production, the farming sector. Those are some of the areas that probably would be on the front line of such a move. As you mentioned, Vice President Harris talking about a stricter policy, but nothing on the level of former President Trump is talking about. And again, another key economic policy where there's a significant gulf between both candidates.
And this is where I would encourage everybody to go read Adam Posen and the Peterson Institute's research on the deportation and the risks for inflation on steroids, and it depends what he can achieve under executive order as opposed to perhaps with a sweep. Enda, thank you so much, Enda Karen there in Washington. And you can find all your upcoming election information, news flow on the terminal. It's ELEC Go. We got it there for you. The polls are live every day. We're counting down to the jobs report. We have a little bit of Fed speak to sprinkle around as well. Mike is off to speak to Goolsby. We'll give you the rundown in just a moment. From New York, good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is only one event globally, 8:30 a.m., the jobs report. Tune into Bloomberg for that. We will then have Fed speak galore for you, which is New York Fed President John Williams at 9 a.m. Mike McKee sits down with Fed President for Chicago, Austin Goolsby, at 10 a.m. I want to get a few stocks in for you. Zim, Integrated Shipping, U.S. dock workers, they've pulled the 3-day strike. The stock is nicely bid this morning. Spirit Airlines, keep an eye on that. Their Spirit Airlines down 41%. Efforts to avoid bankruptcy have hit a snag after months of talks. Bondholders failed to deliver a deal. Summit Therapeutics, drug maker, says the FDA has granted fast-track designation for the use of its cancer drug. Good morning from New York on Jobs Day.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The Fed's laser focused on the labor market.
If the jobs needed does diminish, I think they have to go ahead with the 50 basis point cut.
I think it'll be a decent payroll employment report.
We're going to have a pretty messy payrolls.
This jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. We're coming into Friday with a little bit of good news. Cancel the trip to Costco. Put down the full cart of toilet paper. The strike is over. Live from New York City this morning. Good morning, good morning. It is Payrolls Friday. Your equity market looks like this. On the S&P 500, higher by 0.2%. On the NASDAQ 100, up by a quarter. The main event, 2 hours, 30 minutes away. It's Payrolls Friday. Your estimate in our survey, 150K.
As long as it's between 125 and 175,000 jobs that we get on this headline print, Michael Hartnett over at Bank of America thinks that risk assets do just fine because essentially this would be the Goldilocks nirvana that everyone's looking for. Outside of that band, good luck. And that, I think, is what a lot of people are wondering about.
Look, the White House this morning is breathing a sigh of relief, I think, before we even get the payrolls report, whether it's negative or positive, because we've been talking about the last week, what is it going to be the following payrolls report? Because it's going to be so messy because the dock workers, and I have to say, they're back to work after 3 days. This is a big win.
Let's talk about some mess then. Away from that, let's talk about the commodity market. Crude, 4-day winning streak. WTI and Brent up again by almost 1%. Just short of 80 on Brent, just short of 75 on WTI. The president asked a simple question. Kind of muffled that answer, didn't he?
He was asked, would he support an Israeli strike on Iranian oil facilities? And he said, quote, we're discussing that. So two things come to mind here. One, the president has himself to blame for the spike in crude prices yesterday, which isn't great ahead of a presidential election when Americans care so much about the price of gasoline. And then you have to think, was the president just being honest? We've seen him do this in the past, very transparent when he was asked by actually a Bloomberg reporter in a news conference once about Russia's invasion of Ukraine when Putin had troops at the border. He said, well, it depends on minor incursions. And then it was cleanup again on aisle 6 when it came to Jake Sullivan and the national security team. He walked that back a little bit and said, I don't want to negotiate in public. But the problem is, this is almost like a liability now when he talks to the press.
Lisa talked about this yesterday. What does this commodity market mean to the bond market? Crude up big time yesterday, and bond yields moving in the wrong direction.
Which is the reason why people are wondering exactly whether they are the haven asset in some sort of shock. Question about whether this can stick, question about what we're discussing that I think that would be a little anyways actually means, and I think a lot of people are trying to parse through Joe Biden's response yesterday to those questions. Nonetheless, has this market priced in too much accommodation and too little with respect to some of the inflationary shocks coming down the pike, whether it's oil or whether it's fiscal?
We're talking about it, kinda. Anyway, crude up 5%. just like that. Equities right now on the S&P 500 up by 0.2% as we count you down to payrolls Friday. In the bond market, the 10-year up a single basis point to 385.34. The next hour looks like this. We'll catch up with Chris Verona, strategist, head of key payrolls data. Seth Harris, the former acting Labour Secretary, as US dock workers agree to end a 3-day strike. And Wells Fargo's Michael Pugliese on how low the bar is for another outsized Fed rate cut. We begin this hour with stocks steady ahead of payrolls at 8:30 Eastern Time. Investors looking for clues on the health of the US economy. Chris Verona, strategist at Baird Company, writing, this is equally the most fluid and interesting macro environment we've seen in years. Tech continues to cede leadership. Relative performance is again flirting with the August-September lows, and internals have softened. Chris joins us now for more. Chris, good morning.
Great to be here. Happy Friday.
Why is this so amazing for you? Is it just decidedly convictionless? What is fluid about this?
I mean, you have this intersection of the Chinese going big, the Fed cutting, giving 50 basis points, probably leeway for the rest of the global central banks to do the same. You have what the Saudis did a week and a half ago. So you have this intersection of this remarkable macro landscape, and I think it's a really exciting time to be doing what we all do here.
You always say it's not my opinion, it's what the market is saying. What's the market saying?
I think the market's telling us here, don't be surprised if yields bounce for at least a few more weeks. And that's a change of view for us. We've been so ardent in this bullish bond call for much of the year. I think we've done a lot in a short period of time on rates. We took 10s from 475 to 360. It's actually not uncommon following the first cut of a cycle to see yields bounce. I think that's what we're in the middle of here. I could see 10s, even on an inline report today, starting to drift back up towards the maybe 410, 415, maybe 420 neighborhood. I ultimately want to be a buyer of bonds again. I just think that's a little bit down the road. And what you've seen, John, you've seen rates, dollar, oil, all really correlate with each other here. So something's certainly brewing on that front.
To me, this is actually fascinating. You point to the fact that the dollar is also bouncing, and you think that eventually will weaken as well, but essentially it's going to follow the yield trend. You also talk about how the tech fundamentals are softening when you look at just sort of the charts. Can you talk about what exactly is going on? Is this basically just a market that kind of exhausted itself with this soft landing nirvana, broadening out, and now suddenly you're feeling sort of the last gasps of that?
Well, it's funny, the question we get in a lot of meetings is, Chris, do you think we'll get a soft landing? And I kind of scratch my head at that question a little bit because this market has traded soft landing for the last 18 months. I mean, what could have been more soft landing than rates down, than tech up, industrials and financials leading? So I think the appropriate question is, what comes after soft landing? I think the consensus for a long time has been in the view that after soft landing, you ultimately get the slowdown. I'm not so sure of that, particularly with the Chinese stimulating here. We at least have to ask the question, on the other side of soft landing, do you get some global reacceleration? And I wonder if you do get a global reacceleration, is that what rates or crude or dollar or maybe tech's modest weakening of relative is starting to tell us here? So certainly top of mind.
So at what point would you say this is something more than just a technical blip and something that is durable?
So I'll say it like this. When you look at tech in particular, I think if you got some global reacceleration with rates up, with dollar up, I would be surprised to see tech really reclaim the flag of leadership here. And I think when you look at the internals of tech, which you note, you're down to about 60% of tech stocks in uptrends. That's not fatal. That's not catastrophic. That's not. But it begins to get tougher to consistently make money when the internals are weakening. You've seen that in tech. I think just look at the character of this market the last 8-12 weeks. What's made a new high? Equal weight S&P has, semis have not, right? Value line has, NYSE has, S&P 500 tech has not, Qs have not. So just the character of the advance, I think, has changed in a very real way.
The Chinese stimulus is adding to this fuel and excitement in the equity markets, but really in China. How much is that holding back some of these U.S. stock names?
Well, I think when you look at the move in China, and I say this emphatically, I've only seen something like this once or twice in my career. When you look at the internals, the potency of the move, it's unprecedented. 90% of the Hang Seng make a one-month high this week. I mean, you have to go back to late 08, early 09 to find anything even remarkably in that category. So I think the equity market is saying, at least be open to this being the real deal. I think the question we have to ask ourselves, every durable rally in Chinese stocks over the last 20 years has been accompanied with bond yields rising. So if you look at these Chinese 10s or Chinese 30s, they have to confirm this move. You had a very big move higher in these yields the last 2 weeks. I think that has to stick if we're going to believe this move.
I also want to ask you about the U.S. election. As you're so excited about the macroeconomic environment, you write that your colleague says it's the most exciting election of her lifetime. So what are you doing ahead of that excitement?
Yeah, so I think we have to look at history here. And what we've seen historically is a weak market in October, the challenger tends to win. A strong market in October, the incumbent tends to win. So just from the market's interpretation, I think the next 3 weeks are certainly crucial from that perspective. But maybe more importantly, let's think about all of this intersection between really some changes over the last 2 or 3 weeks, right? We had a very accommodative oil market, maybe not so much anymore. We had a very accommodative rate market, perhaps not so much anymore. So a lot of the kind of key macro variables that we think impact the election have started to shift over the last 2 weeks.
There seems to be a takeaway for equities that Trump sweep, bullish, Harris sweep, bearish. Is it that simple for you?
I think it's probably that simple in the near term.
Where does it get complicated?
I would suspect it gets complicated as we move into 25. I mean, the reality is when Trump won in 16, we went to then doing taxes. In this case, on a Trump win, we have to renew taxes. I think it's a very different view of how the market will interpret that, because if you do nothing, they expire. And you're going to get to the second quarter, third quarter of 2025, irrespective of who's there, and you're going to have to either get this done or it's going to expire. And I think the market will be a very good tell on kind of what's the cyclical impulse behind that.
Just think about the timeline. How quickly do they move for tariffs, and how disruptive is that early on?
This is where I think there's maybe some distance between the consensus and how the market interprets it. If you think about it in a very traditional way, that's going to be bearish China or bearish industrials here, but that's not the message of the market here yet. So I'm always in the game of, okay, what is the consensus thinking and where could they be surprised? And I think there could be a surprise here, at least relative to expectations, that tariffs in a second Trump administration are not as punitive or as potent as being talked about here.
So you don't think necessarily the risk when it comes to the election lies in the bond market as much as people think?
Yeah, I think if anything, maybe, we trade rates up here 415, 420 over the next 4, 6, 8 weeks. And then you actually start thinking about, again, even in a Trump win, when do you start to buy bonds again, right? If the whole kind of impetus of a Trump 2.0 is how do we take our foot off the fiscal accelerator and still manage a relatively modest or benign economic environment, that actually ultimately sounds like rates down, not rates up. So I'm not convinced with this kind of consensus view that if Trump wins, you get some huge move higher in bond yields. History doesn't support that.
Huge with a Y. I noticed that, just sort of an echo of what the former president himself would say. What are you comfortable being long in the super short term then, in the equity market?
I think in the very short term, I want to be long some energy here. I want to be long some crude. I still want to be long some industrials. I think we got to keep an eye on these financials. We've been very bullish on banks for 18 months. They're starting to weaken here a touch. That's a change of view for me. These, Bank of America has softened. JP Morgan has softened.
Or a rate story? What do you think that is?
I think it's a rate story, but it's a change. And anytime there's a change from what the status quo has been, my antenna goes up. And I think there's a little bit of a shift going on in these financials, particularly like the Japanese ones. The European financials have started to weaken here a little bit. So my antenna is up on global financials.
Final one, Japan. He's thrown in the towel.
We've been so long for so long. I think it's time to at least begin to back away. These Japanese banks are starting to weaken. That is the biggest change in our work probably over the last several years. They have been the kind of the tenet or the key of any big macro call, be long Japanese banks. Why are they starting to weaken here? I think it's a question worth discussing.
Chris, it's good to see you.
Thank you.
Appreciate it. A question we'll discuss next time. Chris Verone of Strategas, a Baird company. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Shonali Basak. Hey, Shonali.
Good morning, John. A prolonged strike has been averted. U.S. dock workers have agreed to end a 3-day strike that paralyzed trade on the U.S. East and Gulf Coast. It threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th of next year. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%. And people familiar with the matter telling us that the European Union has voted to impose tariffs as high as 45% on electric vehicles from China. The results have not been publicly made available, but the European Commission can now proceed with enforcing the duties. Sources tell Bloomberg that 10 members voted in favor, Germany and 4 others voted against, while 12 abstained. China has threatened its own tariffs on European dairy, brandy, pork, and cars. And Elon Musk is emphasizing his support for Donald Trump once again. The Tesla CEO saying that he will attend a rally that Trump is holding Saturday in Butler, Pennsylvania. That's the same location of the first assassination attempt on the former president. Musk has already committed millions to the Trump White House bid, including a super PAC that he started that has spent $71 million, mostly on canvassing and field operations to get out the vote. And that's your Bloomberg Brief, John.
Hey, Shanali, thank you. More from Shanali in about 30 minutes' time. Up next on the program, trade crisis averted. We'll speak with Seth Harris, the former acting U.S. Labor Secretary, on the other side. From New York City this morning, good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equity futures right now up 0.2% on the S&P 500. The payrolls report just around the corner, 8:30 Eastern time. In our survey, the median estimate is 150. The range is very wide. At the high end, Jefferies 220. At the low end, Citi 70K. In the bond market, yields higher by a single basis point. The 10-year 385.53. Under surveillance this morning, trade crisis averted. Here's the latest. Cargo back in motion at major East and Gulf Coast ports as a 3-day strike comes to a close. The union extending their contract through January 15. The ILA's local Baltimore president telling local media, quote, "We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months." Joe Matthew joins us now from D.C. for more. Joe, crisis averted for now. Let's talk about how difficult it might be to settle some ground on that language.
Well, look, you're right. This is being framed as a big win for the administration. It's a breakthrough we didn't think we'd be talking about necessarily this morning, and the administration's fingerprints are all over this. But you're right. This is about a half measure here, as Seth Harris will probably tell you in just a moment. The idea of guaranteeing no automation at the ports was just as important as the wage increases for these workers, and that has yet to be hammered out. So we're delaying what really could be the most difficult part of this whole negotiation. In the meantime, though, look, it was this time yesterday morning that Jeff Zients, the chief of staff, was on the horn with the shipping companies. They chose to divide and conquer, it looks like. Julie Su, the acting labor secretary, went to New Jersey to meet with union leaders. And it's interesting here, we can't underscore enough the role that Hurricane Helene played in unlocking this deal right now. The message from the administration was, as Ron DeSantis called up the National Guard to ports in Florida, that we have to get these ports open to get supplies to those affected by the hurricane, and that had played a large role in getting us here today.
Joe, we've seen Kamala Harris try to put some distance between her and sitting President Joe Biden. On this one, does she need to move closer to Union Joe?
It's a great question, Anne-Marie, and how they frame this the next couple of days will be really interesting when she's on the stump. I will note that it's not lost on us that they delivered two separate statements last night. Did you see that? Joe Biden out with one saying collective bargaining works. Then about a minute later, Kamala Harris out with one saying it represents the power of collective bargaining. That sounds like they're singing from the same hymnal, and goes on to say this is about fairness. Our economy works best when workers share in record profits. So yeah, that sounds a lot like Joe Biden talking, doesn't it?
Joe Matthew, appreciate it. We'll build on that a little bit later. We'll catch up with Joe again in the next hour. As Joe mentioned, joining us now is Seth Harris, the former acting U.S. Secretary of Labor. Seth, wonderful to have you on the program with us, sir. Let's just explore this a little bit more. You've lived this. You know what this is like. How set expectations for us? How difficult will it be to resolve the issues around that language regarding automation?
Automation is a sticky issue, there's no question about it, and it goes right to the core of what the ILA and other unions are concerned about, and that is jobs, maintaining jobs for their members. But my sense in this negotiation is that wages was the hardest issue, and the fact that the two parties have been able to address the wages issue in what I think of as a big win for the union, I think that's going to make it a lot easier to finish up the last few issues.
If wages was the biggest hurdle, then why not just end it now? Why are they punting this to January 15th, Seth?
I think they wanted to get the ports open as quickly as possible, and the wages issue was the thing that was going to do it. The automation issue is pretty complicated. There's already language in the contract that addresses automation, but the union wants more, and I think they had to figure out how to craft language that was going to make sense. Benefits issue. I think they just needed a little bit of additional time. We'll see how that turns out.
When you look at the wage increase, 62% increase raised the top longshoreman's wage to just over $63 per hour at the end of a new 6-year contract. Today, that's $39 per hour. Do you think that will push up costs for importers and exporters and potentially still be inflationary to the U.S. economy?
You know, when you're talking about the kind of cargo volume that comes through the East Coast ports, I mean, almost 50% of all imports to the United States come through those ports. That's a lot of money, and the comparatively small amount of money that's going to the longshore workers is just not going to have any kind of macroeconomic effect or price effect for consumers. More likely what it'll do is it'll bring down the profit level of those extremely wealthy foreign corporations that own the carriers and own the terminals. So I don't expect to see a meaningful price effect for consumers at all.
Seth, you've been in the room for these types of discussions. Can you give us a sense of what you think happened between we're so far apart, we're not even coming to the table, to less than 3 days later, we have a deal?
You know, a member of the president's mediation team said to me that even before the deal was cut, that the parties look like they're far apart until they're not. You know, and I think that the owners here, the employers here, realized that this strike was going to go on. The ILA was very serious. The ILA, I think, sort of, I don't know if they did this explicitly, but they almost certainly communicated clearly that they had to get a wage number that was at least as good as the number that the West Coast Longshore Union got, which was about $60 an hour. I think that everybody came to understand that that was going to be the floor, and once that recognition was reached, and let me say it was the Biden administration that put this $4 an hour proposal on the table that the parties ended up agreeing to. Once everybody got to that realization, getting to a deal on wages, I think, became a lot easier.
There's a real question here about the sticking point that they're not going to deal with until January, which is automation. And I do wonder, as somebody who was once in a position of overseeing the entirety of the U.S. labor market and trying to be forward-looking, how problematic is it that people are concerned about their jobs in terms of automation, but if the U.S. doesn't automate certain jobs, it will fall behind and be more expensive in terms of a place to produce goods and to ship them?
Well, I think that's a very, very important question, and I think the best way to resolve it is in the manner that the ILA and many other unions have addressed it, and that's through collective bargaining. We saw a version of this same issue in the Hollywood strikes, where the actors and the writers were very concerned, and also, let me say, the theatrical and stage employees were very concerned about the role of artificial intelligence in their industry, and we've seen that across industries. The best way to do it is for the two sides to come together, for workers to have a meaningful voice at the table and to try to sort it out. Now, I would say that the ports are sort of a unique case because there's only one set of East Coast and Gulf Coast ports in the United States. If you want to bring goods into the United States, those companies have what is essentially an oligopoly, and you have to do business with them. So I think the competition argument isn't going to work all that well because there's just no competition in that market.
Seth, you're the individual who gave the line to the current president when he was campaigning and while he's in office that he should be the most pro-labor union president in modern history. Yet people are starting to wake up to the fact that the leader of this labor union makes close to $1 million a year. Do you think that's going to backfire on this White House?
Well, that really matters only to his members who just got a minimum pay increase of $8,000 each year for the next 6 years. If they think he's getting paid too much for delivering that kind of service, they're going to have some kind of a negotiation over the Constitution. But I'd also point out that President Daggett's salary is about 5% of the average salary of the CEOs in the S&P 500. It's not a lot of money when you compare it to what others who are leading large organizations are getting. Not as many union leaders get that much kind of pay. That's between them and their members, but I don't worry about it in the least. These unions are democratic organizations. They can choose who they want as leaders. They can pay their leaders what they think is the right amount of money. And let me just say, my sense is they got value for their dollar in this deal.
Sounds like champagne socialism to a lot of people, Seth. It's good to catch up. Seth Harris, former acting U.S. Secretary of Labor. I like the way we're like, well, it's up to the union workers if they're okay with their boss. But when it comes to executive compensation, we don't just sit here and say, well, shareholders are okay with it. Is there a problem? Very different approach here.
There is a lot going on. That's all I would say. I'm still wrapping my head around a number of these different issues. It's a complicated moment, especially given the fact that the appearance of being part of the sort of plebeian crowd doesn't necessarily lend itself to $1 million paycheck.
8:15 Eastern Time. Big conversation coming up a little bit later. The National Economic Council Director, Lel Brainerd, first on this program, on this deal, and the prospect of really closing it next month.
And she was in the room. She was on these calls with these negotiations, like what Seth said there, that these two parties look far apart until they're not. And also interesting, the West Coast ports, they're the ones that set the floor and the bar for what the East Coast ports was potentially going to get.
January 15th. Let's see where we are. January 15th in the next few months.
It's an interesting date. That's all I can say.
Yeah.
What made the change to
I know.
January 15th to deal with some of the
We can have that
issues?
conversation next as well. Up next on the program, Bloomberg's Trade Trudell on tariffs on China EVs out of Europe.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Final trading day of the week, going into the weekend. Before we get there, we've got to get through payrolls Friday. That number drops in 2 hours' time. Equity futures right now positive by 0.2% on the S&P 500, heading towards the first weekly loss in about a month. On the Nasdaq 100, we're positive on the session by 1/3%. In the bond market, 2-year yields up by double-digit basis points so far this week, and we had some weight to the move, up by a single basis point at the front end into the 370s at 371.64. We'll spend some time on the commodity market a little bit later, but this is off the back of the move in crude through the week so far.
Chris Verone said that this is notable, and even though he's been bullish on bonds, this makes him think about something different, because what you're seeing right now, you're seeing strong dollar, oil prices up, you're seeing yields higher. It's just the whiff of inflation. And there's a feeling that maybe this is something that is a new trend in markets that cannot be ignored, at least in the near term. That's something that goes to this question, this angst about how a jobs market that's hotter than expected will be treated by this market that's already on edge about inflation.
Just short of 80 on Brent, 78.80 on Brent. WTI yesterday, the biggest one-day pop of the year so far. We'll come back to that in just a moment. I want to get to this. Sterling, good dove, bad hawk. This is what we've seen in the last 24 hours. Stay with me. 131.70 on sterling right now. The pound's a little bit stronger. It was weaker yesterday. So the good dove. Let's talk about Governor Bailey over at the Bank of England. Speaks to the British press, tees up the idea of being a little bit more aggressive. Chief economist Hugh Pill comes out and says, I don't think so. Let's be gradual. Let's be steady. Who's right?
This goes to basically Mickey Bowman versus Jay Powell, or Mickey Bowman versus Austin Goolsbee, right? Austin Goolsbee comes out, we're far away from neutral. He's going to be speaking on Bloomberg Television later this morning. Then you have, Jay Powell, and you have then also Mickey Bowman coming out and saying we've got to worry about inflation, and all of a sudden you get that whipsaw. It just highlights how much this market is hinged on some of the rhetoric and a lack of knowledge of exactly what path some of these monetary policymakers are going to do.
You'd have to believe that Governor Bailey's in the driving seat. Maybe not in the same way that Chairman Powell was in the driving seat at the last FOMC meeting, but you've got to believe the governor's in charge here, surely.
So then, is this a deliberate strategy to try to sort of cool some of the appetite for further rate cuts in the market? Is this basically a messaging tactic, or is this basically free speech and muddy the waters, and then we'll do what we're going to do?
Let's put it this way. The weakness on Bailey, much, much bigger than the strength on Pill. Right? Cable's up by 1/3% today. It was down 1 full percentage point in yesterday's session. I think the market sees it in a similar way.
Especially because inflation is coming down. And I think that basically that's what we've seen with Jay Powell versus Mickey Bowman. Mickey Bowman speaks and people are like, yeah, you're the resident hawk. But Jay Powell speaks and people say, yeah, he's where the committee's going to go.
Sterling, 131.71. Under surveillance this morning, a top story in the last 12 hours. U.S. dock workers agreeing to end a 3-day strike. The International Longshoremen's Association and the U.S. Maritime Association extending their previous contract through January 15. The two sides restarted negotiations on a long-term agreement, which will include a pay increase of about $62
So this is going to end 5 days before the next U.S. president is inaugurated. I think that's very telling. One thing here, it seems, according to Seth Harris, the former acting U.S. Labor Secretary, that they got what they wanted on wages. How difficult are the next few conversations going to be on automation? But the White House taking this as a win. Huge sign of relief that this is done and dusted only in 3 days ahead of this election. They were worried about inflation, and also a huge sigh of relief of everyone out there trying to get a handle on toilet paper and paper towels. My mom called me yesterday saying Costco on Long Island all sold out of paper towels after only 3 days of strikes. This idea that consumers have this reaction post-pandemic, I think, of you have to go out there and hoard because potentially this is going to get a lot worse.
Yeah, I wonder if banana sales were off the hook, especially if people wanted to freeze them. There is a bigger discussion to be had about automation, and I wonder if anyone's going to have it in terms of if the United States wants to produce more goods, especially given that a lot of the factories have been emptied out. How much can the U.S. embrace automation? How much is this a job killer? How much is this a job creator? This, to me, is a larger question, and I wonder how that's going to feature in some of these discussions, because I understand the knee-jerk reaction, but there has to be some sort of larger question mark about how this is framed.
Let's break it down in really simple terms. There were two issues on the table. We've discussed them for the last week. One was pay, the second was language around automation. Most people have said repeatedly the second one is much, much harder than the first. What have we agreed on? We haven't agreed on the second piece of this. All we've done is punt this to January 15th. Now, is it politically convenient? We can have that conversation later in the programme. How did they come up with January 15th? But ultimately, are we going to be back to square one in a few months' time?
Because ultimately, how much can these get to have a meeting of minds when there is a fundamental fissure? Is it political? Well, of course it's political. It's getting to right after the election. Question is, does this mean that we just are basically going to deal with this kind of prolonged strike at that point if there really isn't some sort of agreement reached?
The automation language is existential to these workers. This is about job security in the years to come. It's difficult for this White House that continuously says they want to compete with China. China right now moves a lot of goods in and out because a lot of that is automated.
It's good news. Enjoy the holidays. We'll deal with this in 2025, okay? So let's park this story. Let's get to the really confusing stuff. Israel carrying out bombing raids near Beirut, targeting Hezbollah commanders and facilities. Uncertainty over Israel's potential retaliation against Iran, putting oil on track for its biggest weekly gain since early 2023. Brent absolutely surging yesterday following these comments from President Biden.
Do you support Israel striking Iran oil facilities, sir?
We're in discussion of that. I think that would be a little... Anyway.
Anne-Marie, the floor is yours.
Is he being too honest and transparent, or potentially is the President of the United States being a liability now, not just giving Iran a card to use on the global stage, but also potentially some political pressure on Israel, basically giving us an eye into some of the negotiations that are potentially happening between Israel and the United States, especially given the fact that earlier he said that Iranian nuclear facilities he wants to make sure are off the table. One thing is interesting when you think about the oil market. The president has himself to blame when you see the spike yesterday. But FG Energy came out yesterday saying any disruptions to Iranian oil supplies will likely push oil prices above 80 on Brent. In the absence of that, we can quickly go below 70. The gap is so wide because there's so much supply right now in the market.
That's where I was going to go. Regardless, I'm not going to try to get into President Biden's head, but I can say that the response in markets highlights just how potentially vulnerable this market is to some sort of attack on actual oil supplies in a way that maybe is not fully being recognized in daily trading.
Well, I don't think market participants would just see that strike in isolation. They wouldn't just be thinking about lost Iranian barrels. They'd be thinking about exports across the region being compromised because you've got no idea what Iranian retaliation would actually look like following those strikes.
And we have seen Iran target U.S. allies in the region like Saudi Arabia, Abqaiq, Baghaig. That took serious supplies off the market. So the concern, and people I'm talking to, they're less concerned about what Israel does to Iran. They're thinking 2 steps ahead. What's Iran going to do after that attack?
In other words, are they going to close the Straits of Hormuz? And that's really ultimately the fundamental question about whether that creates a fissure in the oil market.
That is the number one question, Bramo. Crude is up by 1.5%. WTI just short of 75, just short of 80 on Brent, 78.80. Let's get to the latest out of Europe. Bloomberg learning the European Union voted this morning to impose tariffs as high as 45% on EVs from China. 10 member states voted in favor of the measure, while Germany and 4 others voted against, along with 12 abstaining. A kind of a shocker out of Europe this morning.
Especially because the one abstaining was, guess what, Germany, right? You have this situation where Mercedes and BMW sell an astronomical number of cars to China. How do they compete now? And also, to the point that we were hearing about yesterday, how much do we end up with the Trojan horse being the real issue of Chinese manufacturers creating factories in Europe to produce cars that ultimately send money back to China?
1 week ago today, I sat down with Annalena Baerbock, the German foreign minister. My question was, so Germany's on board with the tariffs? When she insinuated to me that I was wrong, saying that Germany was not on board with the walls going up for China, yes. Obviously, we have underlined that if China has tariffs on European cars, then we have to discuss this. Yes, they were on board. They didn't even just abstain. Huge clear signal and pressure from the autos. They voted no.
That is a big difference. Craig Trudeau joins us now. Craig, let's talk about that. The difference between abstaining, voting for, and voting against. What is Germany thinking, and where is that coming from?
I think the automakers really made an all-out push here to get the government to sort of change its view. And it does make sense when you just kind of take a step back and think about, what's happened to this sector just the last couple of weeks. We've seen 3 for 3, Mercedes, BMW, and Volkswagen come out and warn on profit. In Volkswagen's case, it was the second profit warning that they've issued in a matter of a few months. And so, this is an industry that's under pressure. These companies have a huge presence in China that is at risk here, and they're already shrinking in the Chinese market. So to potentially have this additional headwind of retaliatory tariffs in reaction to the EU's move, I think is really concerning folks in Stuttgart and Munich and Wolfsburg.
Craig, let's get into that. Who should be worried? Those automakers? Should it be the brandy makers? Hennessy, the likes of the cognac makers out of France? Should it be the second-tier port coming out of Spain? Who should be worried here?
I think all of the above, and I think we will have a story on the wire shortly if it's not up already. The cognac industry reacting to this morning's vote, saying that they feel abandoned by France. France being one of the member states that voted for these tariffs. China has made quite clear that sector would be affected in its response to these tariffs. So, do we see some movement toward, quotas or price controls and some sort of, compromise here before, it gets, down to the point of these tariffs actually being put into place? They're essentially here already, but the companies are not being charged just yet. So there's still time, and that's something that we've heard, from some of the companies reacting to this. There's still time for a deal to be negotiated here.
So what's happening right now with all of the companies that could be affected in Europe are basically German auto manufacturers leading the charge and going and wrangling up all the other luxury product makers to try to stage some sort of appeal. What's the time frame here?
Yeah, I think the actual implementation and beginning of tariffs being charged, those would kick in early November. So we do have time before then there, as is often the case in Brussels, we see that there are many steps before anything actually goes into place. So there's a lot of elbows being grabbed and sort of ears being turned about just what's going to happen if the EU moves ahead with this. So there are opportunities for sort of stopping this train before it goes off the tracks.
In the meantime, Craig, the fact that Germany voted against it is actually really telling in terms of what are they going to do now? Now that it is being passed, does that mean that they're going to potentially increase subsidies to their auto manufacturers? Are they going to do something else on the other side to try to offset some of the pain that could be inflicted on the likes of BMW and Mercedes?
I think one of the main sort of places where companies are pushing, at least within the car sector, is on the fact that next year we're supposed to have stricter CO2 limits come into place for the manufacturers here. Those already are causing a lot of consternation because of the slowdown we've seen in EV demand. A lot of companies coming out sort of left and right and saying, look, we just aren't going to be able to make it next year. We're going to have to pay significant fines. We're talking billions of euros, and there may be some ways out of having to pay penalties, but those aren't necessarily attractive either. It would mean sending money, say, Tesla's way. This is of course something that we've seen over years now, where Tesla had, I think maybe 5 years ago was sort of assuming that the rest of the industry was going to get its act together, figure out a way to be more competitive on EVs and no longer need to pay Tesla for regulatory credits. That's now a business for Tesla that not only has held up, but is actually taking off. And so that's something to watch for Elon Musk, that, while he's having trouble actually growing this year, the regulatory credit business is looking quite nice.
Craig, I wanted to ask you a little bit more on Germany, in the sense that, do you think the government was divided? Because I got a yes last week when I asked if they were on board with these tariffs.
Yeah, I think there's real divide and real sort of, fascinating evolution here in terms of, the way that this has started. I think it was, there was some unison across member states of, looking at the state of affairs, looking at the way that, just a few years ago, Chinese imports were just a tiny sliver of EV sales in Europe. Last year, they were around 20% of that subsegment of the market. And so real concern that this was also, by the way, not just a matter of Chinese companies sending EVs into Europe, but companies like Tesla, real issues in terms of even European manufacturers leveraging the lower cost base of Europe and potentially using those imports, to boost sales at the expense of local plants in Europe. That's really a cause for concern for folks in Brussels, and the reason why we saw these tariffs come into place. It is fascinating that Germany is now against these tariffs, even as companies like Volkswagen are really at risk as a result of Chinese companies and international companies increasing their presence in China and trying to leverage the fact that they can make EVs much cheaper there than they could, say, in Germany.
Craig, appreciate it. Craig Trudell of Bloomberg there on the automakers. I have to say, we talk a lot about AI and tech. For me, this is the most interesting industry on the planet right now, without a doubt. And I wonder, I think for a lot of cynical people, a lot of people skeptical of Germany's motives here, they'll be wondering whether Germany just knew they'd get the outcome they wanted without offending the Chinese at the same time and just sat on the fence once again.
Well, what it raises the question of is, how do they then counter any kind of retaliation? Can they continue to get away with that in terms of avoiding some of the retaliation from China if ultimately Europe is being lumped together? To me, it raises the question, what's the idea, bigger picture going forward of how to compete on the global scale if you don't necessarily have a countermeasure for any potential retaliation?
Just a quick correction, pork product out of the Iberian Peninsula. It's fantastic. It's not second tier, it's top tier. Okay, just in case I offended anyone. All right, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Shonali Basak. Hey, Shonali.
Hey, John. New Japanese Prime Minister Shigeru Ishiba used his first speech to Parliament to emphasize his top economic priority, which is to defeat deflation. The recently appointed leader shared that he aims to raise wages, boost productivity, revive rural areas, and turn Japan into an investment powerhouse. He has asked ministers in Parliament to support his goals by formulating an economic relief package to ease the impact of inflation. And Barack Obama is launching a 4-week campaign blitz for Kamala Harris. According to a Harris campaign official, the former president plans to begin his election push with an event for the Democratic presidential nominee in Pittsburgh on October 10th. Obama will also appear in ads and robocalls for down-ballot races in the final weeks leading up to Election Day on November 5th. And the New York Mets are headed to the NLDS after an electric elimination game in Milwaukee. After falling behind 2-0 going into the 9th inning, Mets star Pete Alonso blasted a go-ahead 3-run homer to take the lead. It could have been his last at-bat in a Mets uniform, with his contract expiring after the year, and instead, the Mets march on thanks to the biggest home run of his career. They now face off against their bitter division rivals, the Philadelphia Phillies, in the divisional round. John, you know that Steve Cohen is smiling somewhere.
I'm sure he is. I have no doubt about that. Shonali, thank you. I'll tell you someone else who's smiling. The whole of Casabramo yesterday evening. How loud did that get?
Well, okay, I was actually asleep because I come in the morning and very early, and I was woken up as a result of the incredible win with a very excited household that now will be glued to the television screen for the rest of the next week, hopefully.
Well, congratulations to all the Mets fans. Up next on the program, Mark is bracing for payrolls.
As the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points, a couple weeks ago. I think it'll be a decent payroll employment report.
Looking ahead to the payrolls report, we'll catch up with Michael Puglisi of Wells Fargo. This is Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities just a little bit firmer, up 0.2% on the S&P 500. Bond yields just a little bit higher, up a single basis point, 385.92. Mohamed Al-Arian writes in, just wants you all to know that Kaza Al-Arian was up late as well. Enjoying the Mets win. He's going to join us a little bit later this morning.
Congratulations, Casa Alarian. Casa Bramo is very happy for you. Everyone's very excited, and we can't wait to just gloat in a little bit.
Can I just say to all Mets fans, I can't give everyone an individual shout out. Under surveillance this morning, markets bracing for payrolls.
If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question, and that's why the Fed cut 50 basis points, a couple weeks ago. I think it'll be a decent payroll employment report. I mean, I think the estimates are around 140,000. That seems like a reasonable estimate. I think that most of the momentum is for 25 basis points at this point.
So here's the latest. Investors are waiting September's highly anticipated payrolls print in less than 2 hours' time. The median estimate in our survey coming in at 150K among a wide range of estimates. Michael Puglisi of Wells Fargo writing, we are expecting non-farm payroll growth to have slowed slightly to 135 with an unchanged unemployment rate of 4.2. Our forecast for a 25 basis point rate cut at the November FOMC meeting is conditional on a September employment report that does not come in materially weaker than our forecast. Michael joins us now for more. So, Michael, that tees up the first and obvious question. What is materially weaker? What kind of number would you be looking at?
Yeah, I think what it would be to me is, do we come in below 100,000 on non-farm payrolls, inclusive of revisions, right? I think of it collectively, if we beat by 25,000 on the headline for this month, but then there are big negative revisions to previous months, you got to take that into account. And then a higher unemployment rate, right? Not just, flat at 4.2, but does it rise a tenth or even anything higher than that? So you've got to look, of course, at the whole picture, revisions, unemployment, but the way I'm thinking about it is, do we stabilize, right? This is an example of an employment report report, where I think a consensus number is good news, right? 150,000, 4.2% unemployment tees us up for 25 basis points in a month, barring any big surprises.
What's interesting is what's going on in the market right now. There's a rethink of just how much weakness actually is present, given the fact that we've had a number of upside surprises to a bunch of different economic indicators. Yesterday's ISM services data, just the latest in that string. And yet you say that under the surface, there is a stalling out in the labor market that's reminiscent of the 2010s. What are you looking at to see that type of activity?
Well, let me give you a few examples. So one, we're at a 3-month moving average on non-farm payrolls of 116,000. That's not just the slowest since the summer of 2020, but it would even be slow by the standards of the late 2010s. You look at the unemployment rate, which has risen, of course, by 0.5 point or more over the course of the past 12 months. You look at things like the quit rate from the JOLTS data earlier this week. We're back to mid-2010s in terms of the share of people that are quitting their jobs. You look at the survey data and things like the Consumer Confidence Index. More and more people reporting that jobs are hard to get, fewer and fewer people saying jobs are plentiful. And so you look across, I think, a pretty broad range of the labor market data, the establishment survey, the household survey, the JOLTS data, labor market surveys of households, and all of them are showing a labor market that is at best, I think, as strong as it was in the late 2010s, and at worst, kind of more of a 2015 type labor market.
So, Michael, when we look at the markets, we're seeing yields up, we're seeing across the board just inflation expectations tick up just a little bit. There's a feeling that maybe we've reached the trough and that we're going to reaccelerate from here. Do you think that that's misguided, that kind of idea?
I think re-accelerate from here is probably a little bit strong, but stabilize, right? You know, we've seen this downward trend in things like payrolls, upward trend on unemployment, and that's our base case, is that we'll level off from here. That a pace of 125, 150,000 on non-farm payrolls, of a 4.2, 4.3% type unemployment rate will be where we level off, and that we won't see that deterioration any further. But, you know, we're not looking for an acceleration from here to a 200,000 plus, non-farm payrolls pace, or 3% plus GDP growth in kind of the next few quarters.
Who knows what's in store at 8:30 Eastern Time. Michael, we appreciate your view, sir. Michael Puglisi of Wells Fargo on the latest jobs report. 150 is the estimate in our survey. You just get the feeling, and we've had a lot of people come on this program and share this sentiment, that whatever the number is, people are just mentally adjusting that number down. And when I say people, I don't just mean investors and neutral observers. I mean people at the Federal Reserve as well, officials, central bankers.
Yeah, well, I wonder how much we're going to end up actually looking more at the revisions even today to see whether that trend continues. Because if we see ongoing downward revisions, then it will just confirm that typically when you get a weakening labor market, you do get those negative revisions. And the more that continues, the more you'll keep adjusting downward any type of headline number.
We've played up payrolls a lot. We've played down CPI. I think there's a few people out there pushing back against that view too. This was from Bank of America. Governor Waller's remarks explaining the rationale for a 50 versus 25 at the last meeting should support expectations for a front-loading of cuts with the disinflation trend intact, even if the labor report surprises to the high side. CPI next week is equally as important in some people's minds.
If people see inflation coming down as reason enough for this Fed to try to get to neutral, if that alone suggests that neutral is much lower, then essentially the jobs market shouldn't stop them, right? That ultimately strength is a good thing. And if CPI keeps on coming in lower, well, the carte blanche, go ahead.
Get back to neutral quicker.
Exactly.
It's the view of many on Wall Street, including, I believe, Neil Dutta over at Renmac, who no doubt will write in a little bit later this morning. Priya Misra is joining us next of JP Morgan. We'll catch up with Evan Roth-Smith of Slingshot Strategies. We'll speak to Ellen Zettner of Morgan Stanley, who caught up with Chairman Powell this week. That's going to be interesting. And we'll talk to Becky Frankowitz of Manpower Group, just what is going on with hiring from New York City. That's all up next in the second hour of Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Won't have to cut as many times as the market is expecting because of a reacceleration in growth.
We do disagree with market pricing that takes policy rates to below 3% by the end of next year.
I think Powell set up the case for 25 a couple of days ago when he spoke.
I think that most of the momentum is for 25 basis points at this point.
The idea that the Fed's just going to deliver 2 25 basis point rate cuts, I think, is a problem.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
I knew Neil would make an appearance at some point. There he is from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. The price action looks like this. Here's a flavor of things. Equities just a little bit firmer, up 0.2% on the S&P 500. On the NASDAQ, up by a little more than 0.25%. The main event 90 minutes away, so here are some estimates for you. The median estimate in our survey is about 150. The range is incredibly wide, 220 at the top end. That's the high from Jefferies. At the low end, Citi going with 70.
So question is good news bad news? Is bad news bad news? Is good news good news? Anyone who's rolling their eyes, join the club. Yesterday, Jack Manley of JP Morgan Asset Management saying that actually on the margins, good news could be bad news just simply because this is a market that is more hinged on the idea of rate cuts. Basically, Bank of America coming out with Goldilocks, which is 125 to 175,000, and that would be game on for risk assets.
John, when you look at those analyst estimates you just ran through, 150,000 jobs is the spread. It's absolutely massive. It just makes you think no one really knows what's going on, which goes to the second point, which is the fact that even Jay Powell's talking about the fact that how reliable is this data? This morning, Paul Donovan over at UBS, the monthly celebration of dubious quality data that always thrills markets. Basically, whatever number you get, you have to take a grain of salt with it because maybe 60, 70,000 will come off in the revisions.
We mentioned this in the last hour. There's just a feeling for a lot of people. They mentally adjust this number lower by that 50, 60. Lisa said it last time around, and she was absolutely right. For a lot of people on Wall Street, the focus wasn't the headline jobs number. It wasn't the unemployment rate. It wasn't even wages. It was the revisions.
And so we'll get that again today. All I can say is way to pour cold water on what we do every single day. But this is sort of what the markets are doing every single day, too. And so, you can make a joke about how it is sort of this fictitious number that's going to get revised up, down, and center. But at the same time, the market's going to trade on this. And guess what? The Fed has to make a big decision based on this data.
An even bigger decision on November 7th when they meet. And there was a payrolls report that comes early in November that could have been even messier for them. Some good news. Less messy. Just a little bit less messy. The 3-day strike on East Coast and Gulf Coast ports, over for now. We're going to do this all over again potentially on January 15th.
Yeah, that November 1st payroll report, looking back at October, obviously is going to become a little bit more reliable for the Fed. Now that we have those workers back at the docks, punting this to January 15th, 5 days before the inauguration, before the next U.S. president, they got a deal on wages, 62%. And Seth Harris, who's the former acting U.S. Labor Secretary under the Obama administration, saying they really wanted to make sure they were in line or at least beating what happened at the West Coast. Now this language on automation, they say it's potentially easy. It looks like it's the more challenging one. It's existential to these labor workers.
There are short-term decisions and there are long-term decisions. The short-term decisions are things like wages. Long-term decisions, and I think you could talk about the U.S., I think you could talk about Germany in this as well. There is a larger, real key question about how you're going to deal with fundamental shifts underpinning this economy, and that has to do with automation, it has to do with where things are produced, and it has to do with the West's relationship with China. All of those things kind of coming together and being pushed out further and further because no one wants to actually deal with them.
We're going to have that conversation later on this morning, 8:15 Eastern Time. The director of the National Economic Council under President Biden, Lael Brainerd, is going to be joining us on this program at 8:15. Do not miss that. Here's a flavor of the price action for you. Going into payrolls, equity futures just a bit firmer. I want to pick out one thing on this screen. Crude, very close to 75. Lisa, up by 1.4%, a 4-day rally.
And it comes after Joe Biden responded to a question about whether Israel could potentially strike the oil assets of Iran. He said, quote, "We're discussing that. I think that would be a little anyways." And here is what it really ignited the 5% rally that we saw yesterday. Key question is, how far could this get escalated?
Dissecting Joe Biden speak, that anyway was basically, oh, I don't think I was supposed to be this transparent.
I would agree with you. He was thinking out loud.
He was thinking out loud, and he's
a little bit of a liability given how sensitive some of these negotiations are right now.
A liability, and also basically his administration, I think, is concerned because it's an election year. And you have to think Amos Hochstein was sitting there putting his face in his hands being like, oh my gosh, I'm trying to keep a lid on these oil prices ahead of an election. And you basically just said, yeah, maybe Iranian oil facilities are game on.
The president sparked the biggest one-day rally in crude of the year so far. WTI right now just short of 75, 74, 77. Coming up this hour, we'll catch up with Priya Misra of JP Morgan saying bad news for jobs is bad news for risk. Evan Roth-Smith of Slingshot Strategies as Elon Musk says he'll join Donald Trump on the campaign trail, and Ellen Zettler of Morgan Stanley after her conversation with Fed Chair Jay Powell earlier this week. We begin this hour counting you down to US payrolls at 8:30 Eastern Time. The median estimate in our survey expecting a print of 150K. Priya Misra of JP Morgan writing a print of 150 or higher, and the Fed will likely cut 25 in November. Payrolls around 100K or below means 50 basis points. Bad news on jobs, bad news for risk assets, and the curve should bull steepen. Priya's with us around the table. Priya, good morning. It's good to see you. I've got one question in the bond market, and then we can go broader and we can talk about payrolls. Why is so much money, so much cash going into money market funds right now?
Great question. As we hit another record yesterday, I would say one word: valuations. You know, the fact that you're still getting 4.5% to 5% on money funds, the yield curve is still inverted. Every asset class is priced for a soft landing. So I think people are staying in cash, waiting for better levels on bonds, better levels on stocks. I will say we're seeing significant inflows into bond funds, but people are waiting for, well, I'll buy when the 10-year treasury is at 5%. You're not getting that. You know, inflation's coming down. The Fed's telling you they're going to cut. We don't have to read between the lines on the Fed put. They're telling you it's there. If things weaken, they're going to cut much faster. And I think people who've been sort of, you know, there might be a melt-up move, because if you get a short period of volatility, we are absolutely going to be in there buying if there is a risk-off. But I think, you know, there's a sense of everything is so well priced, everything's done well. Let me just stay in cash. It's still giving me 4.5. Well, within a year, it's going to give you 2.5 or 3%. And, you know, that's when I think a lot of that money is going to start to move out.
Although it comes at a time when people are taking a look at what's going on with the oil prices. They're taking a look at what's going on with the resilience and a number of different indicators. Yesterday, we had ISM services data that came in better than anyone expected, who was surveyed by Bloomberg. And you have to wonder whether people are questioning this idea that the Fed is willing to go 50 basis points so quickly. You heard a slew of people lining up, 25, 25, 25. And then Neil Dutta saying, no way, stop it, guys. How much do you see this as sort of a given, even though you are seeing signs of strength in so many places?
So I think the data is really mixed. You can see signs of strength, then you can see signs of weakening. Look at that unemployment rate increase. Look at labor differential in consumer confidence. I think this is where the earnings report, details of the job report. You've been talking about revisions. I think revisions, look at dispersion within jobs. Is it really only 2 or 3 sectors that is creating all the job growth? What happens with margins? So I think there is, you know, a lot of uncertainty. The data is not giving us a clear picture, and every market's priced for soft landing. So I think this is where I would push back. The re-acceleration risk seems to be off the table. I think we've got really a bimodal world. You've got these binary risks, and there's a lot between the election, between geopolitical risk, between payrolls, frankly, or the entire jobs report. We're either stay in soft landing, everything is priced in, but can rates fall some more? Sure. Can spreads tighten? Absolutely, if we stay in soft landing. or we go much worse. And I think that's the world that we're sort of grappling with.
And that's the reason why you think good news is good news for risk assets, because ultimately you do think that that reacceleration is off the table. I want to pick up on that. Are you basically saying that this head fake that we're seeing in oil prices is a head fake, and that any kind of tick up in yields is a buying opportunity right now because ultimately inflation is dead?
I think so. I mean, oil price increase through supply related issues, which is what this is, that's actually a tax on consumers. So I think if it's geopolitical related, I would not buy it. If there's massive fiscal easing in China or significant fiscal easing in the US, which actually creates growth, then it's a different question. But I think oil prices is negative. Bonds are a diversifier for risk assets. We saw it the last two payroll reports. We had slightly weaker numbers. You got, the market pricing in this higher chance of 50. Rates fell. And that's why I think, if you get weak numbers, we're going to price in 50. And the whole idea of why did the Fed go 50? All those reasons are still, present today. Monetary policy is restrictive. What's 150 basis points really going to do? I think, friends. Well, exactly. I think for the housing market, you need mortgage rates much lower. We're talking 4%, 4.5%. We're not, at 6%, you're not going to have that happen. You're not going to create a big positive on the housing market. So when I think about reacceleration, I look at where are the drivers. It's not rates. You need much lower rates. It's not really fiscal so far. This is where the election, this is where China becomes important. So right now, I would say oil prices, and that's resulted in this rise in rates, it's absolutely a buying opportunity. If you've got risk on your portfolio anyway, and we do, we get a little nervous about, all these binary risks. I think owning some hedges, be it steepeners, owning some duration, especially given this backup, it's an opportunity.
Priya, let's talk about the election. You went there. You say after the jobs report, the market's going to be solely focused on the U.S. election, and you say the market will move in any scenario since it is not priced for any scenario. But if you have conviction that you think Harris is going to win with a sweep or Trump is going to win with a sweep, how should you be pricing that?
It's very hard. I would say your key point was the sweep. I think what happens if it's not a sweep? But I love that you bring up sweep because I think everyone focuses on the White House, not y'all. I know y'all have talked about Congress. Congress is very, very important. So what happens with the House? And this is where the House is at a knife edge. The presidency, look at polls. I'm not even sure we can trust polls a whole lot, but the polls are very close. So, and then look at all the policies we're talking about, right from tariffs, which actually doesn't need Congress as much. Fiscal policy absolutely needs Congress. Immigration, regulation. There is so much out there that we're going to have to see, what's the make? Will we know the result on election night? I hope for all our sakes that we do. But what if we don't know that? What if it's a divided government? Then we have to see what is priority number one. And there's something on the campaign trail, and then there's actually what they talk about. So I think for the market pricing, we're going to move in either direction because there's so many unknowns around the makeup of Congress, around the presidency, and then what policies are their number one priority.
And what happens when the FOMC meets and we don't potentially have an election result?
I think they look at financial conditions and the economy, clearly. If monetary policy is still restrictive, which is likely to be, we're going to be in the 4 handle. We can debate R-star and say maybe neutral rate is not 2.5, but 3.5. It's not 4.5 or 5. So I think they continue to cut. They're going to try and be as apolitical as they can. Look at the data, the entirety of the data, inflation and growth. I think Governor Waller tells us inflation is also important. So we have to look at both. And then look at financial conditions. In the scenario where we don't have an election result, financial conditions will tighten. Because markets don't like uncertainty. You don't want binary outcomes which you don't know how to price. In that scenario, I think they cut and they tell us, well, if financial conditions continue to tighten, we'll cut more. I think that's the message we'll want to hear.
So final message from you. I'm sitting in cash, like so many other people. What do I do? Where do I go?
I think you buy bonds.
Okay.
I don't want to talk my book, but I think...
Well, I had a feeling you might turn around and say it might be the Core Plus bond ETF.
If you're getting, investment grade, securitized, high yield bonds, high quality, I think high quality fixed income is sort of the best place to be in right now. Spreads are tight, but look at all in yields. You're getting 5.5% higher than money market rates. So if you're in money funds, you're getting 4.5, or you get 5.5. And it's going to be a diversifier, especially if one of these events, when we talk about October surprise, we have multiple contenders for the October surprise. If any of them pan out, you've got that yield and you've got that hedge.
It's a massive month ahead. Priya, it's good to see you. As always, thank you. Priya Misra there of JP Morgan Asset Management with an update on stories elsewhere this morning. With your Bloomberg brief, here's Shonali Basak. Hey, Shonali.
Good morning, John. Cisco has agreed to invest in cloud computing provider CoreWeave, according to people familiar with the matter. The transaction values the company at $23 billion. The potential secondary transaction would allow existing shareholders, such as employees, to tender $400 million to $500 million of their holdings. Bloomberg reports that the deal is not yet finalized, but near completion. And 7&I is eyeing potential buyers. Bloomberg is reporting that the 7-Eleven owner is exploring a sale of its Ito Yokedo stores and supermarkets. According to people familiar with the matter, the Japanese retailer has approached private equity funds and other entities about the sale of multiple businesses under the supermarket empire. The potential sale is part of a greater push to show a greater focus on the retailer's convenience store business. And the man who predicted the double-digit returns in Chinese equities this year now has concerns about current valuations. Invesco China CIO Raymond Ma shared that he believes that there are signs that the surge has gone too far for some stocks, adding that some lack a clear value proposition based on their likely earnings performance in some sectors. But Ma isn't bearish on an opportunity in China. He says there's still plenty of scope for investors to be making money buying Chinese stocks. And that's your Bloomberg Brief, John.
Charlie, thank you. You made a ton of money in the last few weeks, that's for sure. Up next on the program, tension on the campaign trail.
I ask you to stand in truth, to reject the depraved cruelty of Donald Trump.
If Lion Kamala gets 4 more years instead of a golden age, America will instead be plunged into a dark age.
We'll get to the latest polls up next on the program, live from New York City. On this Payrolls Friday morning, good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
was going to keep rain World Cup. This is a three
As the economic picture
covering the intersections of Hollywood, Silicon Valley.
Payrolls dropping in the next hour. Equity futures into that firmer by 0.25% on the S&P 500. In the bond market, yields a little bit higher, up by a little more than a basis point. The 10-year 3.86. Under surveillance this morning, tension on the campaign trail.
I ask you to stand in truth, to reject the depraved cruelty of Donald Trump. And I ask you instead to help us elect Kamala Harris for president.
If Lion Kamala gets 4 more years instead of a golden age, America will instead be plunged into a dark age. Your family finances will be permanently destroyed. Your borders will be gone forever. They already are when you think of it, right?
Here's the latest this morning. Powerful allies joining Kamala Harris and Donald Trump on the campaign trail. Former Republican Congresswoman Liz Cheney urging members of her own party to put patriotism over partisanship. This as Elon Musk says he will attend Trump's Saturday rally in Butler, Pennsylvania, the site of the first assassination attempt on the former president. Joe Matthew of Bloomberg joins us now from the nation's capital. Joe, let's go to the polls. How are things stacking up?
Well, my gosh, it depends what poll you're looking at, but this race is statistically tied in pretty much every measure when you factor in margins of error. It's really hard to say who's leading where. When you look at the swing states that matter, it's within 2 points pretty much in either direction. We talked to the Cook Political Report last evening on Balance of Power about their latest numbers. Tied in both Georgia and North Carolina, where you're finding both candidates this week, of course, surveying some of the hurricane damage here. But you're right, we've got some star power at play. Elon Musk is going to be in Butler. I suspect that's well within his right because he's largely paying for Donald Trump's ground game right now, $71 million through the super PAC. I wonder if he might end up speaking at some of these rallies over the next month. And Liz Cheney, interesting optics yesterday. That was the image of the day for these two who don't agree on a single political issue to share a stage together. She told the crowd that she's been a Republican longer than Donald Trump has been spray tanning. I wonder, however, if it brings any undecided voters into the fold.
Joe Matthew, down in Washington, D.C. Joe, thank you, sir. Joining us now around the table, Evan Ross Smith of Slingshot Strategies. Evan, good morning to you, sir. It's good to see you.
Morning.
Had a lot of people come on the programme since the vice presidential debate and suggest that Senator J.D. Vance did a pretty decent job of prosecuting the case and tying Kamala Harris to the Biden administration, of which, of course, she's a part of. Is that gaining any traction in the polls?
He did do a good job of tying her to Biden. And, you know, as we run out of moments that could change the trajectory of this race, right? There's a 60 Minutes interview coming up, but there doesn't seem to be another debate, whether presidential or vice presidential. Whether or not Kamala Harris chooses to break more decisively with Joe Biden is one of the few remaining questions in this election. We've done some testing that shows that it's a pretty good idea for her to draw some contrast, some sharper contrast with the president, but in very specific ways, which is to pick a high salience issue like the economy, really inflation and price levels, or immigration, and say, I disagree on how we did this, on how Biden did this, and I'm going to do it differently, rather than saying, oh, I'm young and energetic, or, you know, we got some things right, but some things wrong. You have to get specific on something that voters care about and say, I would do it differently.
So a move from vibes to policy. Where does she need to actually inch closer to Biden?
Well, you know, there are things that Biden did that were very popular. You probably aren't going to like this, but when we test ways she could break with Biden, the most popular thing we test is her saying, you know, Joe Biden had to bring the country back from the depths of the pandemic, but corporate America got away with a lot over the last 4 years in terms of raising prices on hardworking Americans. I would be different. That tests off the charts. Number two thing is I would approach the border differently. But there are things, and of course, Joe Biden has been pretty tough on prices, and you know, he's invested in supply chains. He's done a lot, but people just don't know about it. So you're really telling people something that has already happened, but the electorate wants to hear it.
The one place where I think she probably needs Biden's help, I want to say, is the unions. When you look at the data coming out of Teamsters, because they've published all this internal data for rank and file, Biden earlier this summer was actually beating Trump. Now the numbers are Trump 58%, Harris 31% when it comes to rank and file. How important for her is it to talk to those working class individuals in places like Erie County, Pennsylvania?
Well, it's very important. I mean, the composition of the Democratic electorate has shifted where, you know, the suburbs of Philadelphia probably weigh more on the Democratic conscience in terms of who's going to win this election than you know, the industrial working class of Pennsylvania. But that hasn't stopped her from doing things intelligently, smartly, by like signaling on fracking and other industrial jobs, and signaling a major investment in manufacturing, you know, subsidies for small businesses, things like this. So the working class is very important. Unions are very important. This is probably the most tension we've ever seen this late in an election cycle between the Democratic Party and major national unions. But it's fairly contained, really, to the Teamsters, who have been shaky in terms of their commitment to the Democratic Party for a while, and the kerfuffle over the ILA.
There's a number of different constituents that you've kind of keyed in on, and they have different issues that really are, in particular, that need to be catered to them. When you look at some of the October surprise catalysts, you look at the war in the Middle East, you look at the hurricane and the recovery from Hurricane Helene, you look at the potential for a wobble in the economy, which issue do you think could potentially be most damaging to either candidate going forward?
Probably any major change in the economy. Foreign policy is already the weakest rating that Biden gets as president, but voters have never really tied Harris to his foreign policy. He will have to deal with it as president, and it could affect his legacy if something changes in a major way in the Middle East. But, you know, not to be a nothing ever happens guy, but it seems like we have a fairly well-structured election going into Election Day of Harris up a few points in the blue wall states, tied or trailing. You know, your polls show her more or less tied or even with a slight advantage in the Sunbelt states, and reaching a sort of resistance level of +5 nationally.
In 2016, there was a lot of criticism about the polling, saying that people didn't want to say to pollsters that they were going to vote for Trump. And that was one of the reasons why a lot of the polls didn't pick up how much support he actually had. Is that true this time around?
I have a sort of contrarian take on this, which is, you know, the error that pollsters are most prepared for, because of the last 2 cycles where there's been a polling error that undercounted Donald Trump's support, is exactly that polling error. We have, you know, the whole industry has examined, are we getting these people, are we getting those people? We have to make sure we get all the Trump people. You know, the modal error, the one we're not prepared for, is some sort of pocket of support for Kamala Harris that we don't know about. We know what it looks like when Donald Trump runs for president. We have a lot of data. We've had a lot of time to prepare. You know, non-college working class voters, right? All of these things that have really stymied accurate polling is largely accounted for. Now, there could be another surprise, right? You know, Muslim voters in places like Michigan, maybe. But we don't know what Kamala Harris looks like at the top of the ticket. If there's a surprise to come from somewhere, it's probably from her.
Evan, appreciate your time. As always, thank you, sir. Evan Ross Smith there, Slingshot Strategies. We've said repeatedly for the last few months, things are incredibly finely balanced going into this election result a month away, if indeed we do get a result in the next month.
It's on a knife's edge when it comes to the election and in the swing states. I keep going back to the unions, not just because what happened with the dock workers, but also last night, the Democratic Party got a blow from the firefighters. They are not going to be endorsing Harris. And when you look at rank and file, they lean towards Trump, at least definitely in the Teamsters, which share their data.
We'll stay on the labour market. Coming up next on the programme, we'll catch up with Ellen Zentner of Morgan Stanley Wealth Management as we count you down to payrolls in just over 60 minutes' time. Ellen Zentner sitting down with Chairman Powell earlier this week. We'll get her thoughts on her biggest takeaway with the Federal Reserve Chairman. And we'll look ahead to this one at 8:30 Eastern. In our survey here at Bloomberg, the median estimate is 150K. The previous number is 142. Going into this, equities rallying just a little bit, up 1/3 on the S&P 500. In the bond market, yields drifting just a little bit higher. But the main event this week hasn't even been the economic data. The main event this week has been in the commodity market. Crude is rallying for a 4th consecutive session. We're heading to the biggest weekly gain of the year so far. WTI just short of 75, 74, 76.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
2 hours away from the opening bell, 1 hour away from the jobs report. Equities look like they're up 1/3 of 1% on the S&P 500, still heading towards potentially the first week of losses in about a month. On the Nasdaq 100, we're up by 0.4 of 1%. On the Russell 2000, we're up by 0.5. I want to tie two asset classes together, bonds and commodities. Let's start with treasuries, 2-year, 10-year, 30-year, and let's pick out the 10-year segment. Yields up for a third consecutive day, up 2 basis points this morning, 3.8630. Up big time across the curve yesterday, and this is the why. Let's talk about the commodity market. The biggest one-day pop on crude just yesterday that we've seen so far this year. Brent crude just short of 80 is 78.67. Lisa, you've been tying these two markets together over the last few days. This is what Ian Lincoln of BMO has to say. It's far less obvious that the conflict in the Middle East will be traded solely through the lens of reflationary risk. At some point, we'd assume the inflationary impulse will give way to safe haven demand and global growth angst.
Well, Priya Misra was saying this, that basically there's good inflation that actually signals a growing economy, and there's bad inflation, and that is commodity inflation from some sort of geopolitical crisis, and that usually suppresses growth and is a flight to haven type of moment, which is the reason why they continue to be bullish and see this as a buying opportunity. The sort of fly in the ointment here is that the economic data coming out at the same time in the United States has been better than expected. So trying to unpack the two asset classes can be a little bit more difficult than it otherwise would be.
Also, looking at the supply and demand picture of oil, right now prices are higher just because of a war premium, this conflict premium. That also, basically, the President of the United States did to himself yesterday when he basically was very transparent and said, yeah, we're discussing that when it comes to Israel maybe targeting Iranian oil facilities.
And instantly, 5% move on crude. I'm pleased you brought up the data. We'll spend some time with Ellen Zentner of Morgan Stanley. Spend some time with her on this in just a moment. The ISM services, again, it was another one of those prints that had something for everyone. So you had the headline read, fantastic, new orders, great, and then the employment component, well, bit of a problem here. So the same thing in job openings, didn't we? Layoffs were very low, but hiring's come down. Quits rates fallen. Got a problem here. That kind of conflict, those contradictions, we see it in the data repeatedly again and again.
It was the same with JOLTS. It was the same with ISM manufacturing. It was the same with ISM services. You look under the hood at the employment market, and that's why people are saying it is treading water. That's the reason why people say that you're on a knife's edge to the downside, not necessarily to some sort of reacceleration. Key question to me is, what makes it break one way or another? Does the Fed's 50 basis point rate cut help it break to the upside? And if that's the case, are we seeing the trough, or is this the beginning of something more prolonged?
Or can we just stabilize here for a while? Hopefully.
It doesn't ever work like
Hopefully.
that. Okay, I understand that.
Hopefully.
I hope so too.
Just,
Me
too.
too.
We all hope so. We're all sharing that dream, all right?
Let's do that.
Come back to that in a moment.
Come back, yeah.
Under surveillance this morning, US dog workers agreeing to end a 3-day strike after reaching a contract extension through the middle of January. Workers will return this morning with the two sides set to restart negotiations on a long-term agreement, which will include a pay increase of just under 62%. The pay has been addressed. But one thing that hasn't been addressed in a major way, language around automation, and that ultimately is the bigger issue here.
It is, and I think, Lisa, you put it well earlier. This is short-term gain, but long-term, it's the anxiety about what these ports, what these jobs will actually look like, and they are trying to really quell the concerns about automation, because that is the direction of travel for how these ports operate, especially when you look at places like China and how they're doing it. What I can say, a massive sigh of relief coming out of the White House. You do not want to have to decide on whether or not you want to be on the side of the U.S. economy or the side of labor unions before an election.
That said, I would like to understand what kind of master plan there is, not that there ever is a master plan, but what kind of concepts there are with respect to the balance between automation for longer-term structural sustainability with respect to some of the manufacturing and the ports versus job creation. That's sort of the question of when we talked about globalization, how do you also keep jobs here? Where is the discussion about how to bridge that gap so that a lot of people don't become out of work?
We'll have that discussion at 8:15. Director Brainerd from the National Economic Council. Look out for that conversation on Bloomberg TV a little bit later on this morning. So this is the good news for the Federal Reserve. This data is going to be really messy. It'll be less messy now, but there are still some difficulties in this country, including this one. Rescue crews continuing to search for survivors in the areas around the floodwaters of Hurricane Helene. The death toll rising to at least 215 people, with more than half of those in North Carolina. Hundreds more remain missing.
The pictures are devastating, and people have lost their livelihoods, and a lot of people moved to some of these areas, and they didn't even think of some sort of hurricane risk. Now the question is, and actually a real big concern, and we talked about this with the governor of, with a Congress member from Tennessee, if we get another storm, even a big bout of rain, and there is another one coming, how much does that add to the complications of recovery and rebuilding of a lot of these areas?
One, when is Congress going to come back if they need more money in terms of supplemental funding? But also these two stories, when it comes to dock workers and the hurricane, are connected. It was that final push to the union to say, okay, actually, emergency materials are needed. We cannot hold the economy hostage at this time, when now Hurricane Helene is now one of the deadliest storms in modern history.
A really difficult moment for the people of those states. We'll continue to cover that story, of course, on Bloomberg TV and on Bloomberg Radio through today. I want to turn to the latest out of China. Economists at Nomura warning that China's historic stock rally could quickly turn to a bust. The bank's saying that China's economy stands on much weaker footing than it did before the pandemic, with a number of vulnerabilities, including its housing sector, high local government debt, and geopolitical tensions, including the tensions around the automakers in Europe this morning, which is the latest news we got out of the continent.
Saying it could go back to 2015, the boom and the bust, and sort of the losses that people saw after that. Okay, I get it. That's why people are saying it's a trade. It's not necessarily owning it, right? They're renting the trade, but they're not owning it. Let's see what they can do. I mean, we also hear from some economists saying that the bazooka could mean $1.4 trillion of bond sales to fund stimulus. So I think a lot of people are in wait-and-see mode.
Everyone was all excited. They went out for the party, but now they're waking up to the hangover, and that is the fact that, look at I can't get over the youth unemployment rate in China. It's near 20%, and that's the data we know. So what you see now is any of this going to trickle down to the real economy? That's the big question mark.
Christian Mamani raised this, and I think it's a really interesting point. He referenced the post-GFC period in the US economy, and he said the policy reaction ultimately did enough to stabilize financial markets and lift financial conditions, but it didn't do enough to address the economic vulnerabilities, and it remained that way for a long, long time. And he's making the suggestion that maybe that's what we're seeing take place in China right now. It's enough to lift markets. It's not enough to address the weakness that we see, the vulnerabilities we just pointed out in the broader economy.
How many times do we say the stock market's not the economy?
All the time.
How many times do we say that the financial markets and the conditions there are getting increasingly divorced from the fundamental economy? If that's true in the United States, just think how much more so in China.
Really interesting point. Let's turn back to the US economy. It's all about the labor market.
So many measures, the labor market is still solid, but it really has cooled. Our conditions have cooled considerably. And as I mentioned, we don't think that labor market conditions need to cool further from where they are. The measures we're taking now are really due to the fact that our stance is due to be recalibrated, but at a time when the economy is in solid condition. That's what we're doing. We're recalibrating policy to maintain the strength in the economy, not because of weakness in the economy.
There is a familiar face on the left side of the screen there. That's Ellen Zentner of Morgan Stanley Wealth Management. Ellen, good morning to you.
Good morning.
Fantastic conversation earlier this week. Congratulations.
It was a really great conversation. We covered a lot of topics.
What was the big takeaway for you?
So Chair Powell seemed very relaxed. His baseline is 25s. You heard him. The economy is on strong footing. I think it was easy going into this conversation that we had important data last week showing that gross domestic income had such a significant upward revision, where we had more spending, more income, and the savings rate still got revised up, meaning we also have a greater savings cushion than we thought. You pair that with the coming downward revisions we know or we're going to get on employment, those are huge productivity numbers. And so that's a lot of comfort for a policymaker that might have been worried that consumer spending was going to drop off quickly or jobs were going to drop off quickly. So it was a pretty relaxed conversation. But importantly, I wanted him to say publicly that that employment report during blackout before their November meeting will matter. And so that's one reason why I'm only focused on the unemployment rate today.
So this introduces your own analysis of the situation. So let's get to it. How low do you think the bar is for that 25 that you've got penciled in to turn into a 50 in November?
I think the bar is fairly low if the unemployment rate continues to rise. And here's the thing, you can get a healthy employment number today. You can get a healthy employment number in November, but if the unemployment rate continues to rise, because that keys off of a different report. That's the household survey report, and that is the sole measure that Chair Powell is watching. And so if that continues to rise, well, you've hit your threshold. You said we won't tolerate more weakness in the labor market. And so I don't think, especially when rates are this high, that there's a particularly high bar to get to 50.
That said, even Jay Powell has talked about how the rise in unemployment doesn't represent a weak market. It represents an increase in the overall jobs market in terms of the supply of workers. So why does this sort of become the most important indicator if he himself has said maybe it's not measuring weakness per se, but just a change in the demographics of this labor market?
So I think that very much has been the case for some time. He talked about the impact of immigration, greater supply into the labor market, and for some time that has been driving the unemployment rate higher, and it represented just a better balanced labor market. But we moved into balance some months ago, which means we're starting to move into an oversupply at a time when companies are slowing hiring. And so further rises in the unemployment rate will be for the wrong reasons.
Did you get a sense that Jerome Powell is fundamentally more dovish than the rest of the committee? Because we've all just been assuming that that's the case, and that's what we get from the rhetoric. But did he seem to feel like he was really the consensus in terms of having this predilection to making up words today, it's Friday, excuse me, to cut by 50 basis points?
So I think that the fundamental issue is that the economy is okay, and there's not any forcing issue here to cut rates. When the data is deteriorating quickly, when it's sort of slapping policymakers across the face, you'll see how quickly consensus comes together. And so it seems very disparate on the committee because there's no particular emergency, right? You're cutting in a healthy economy. It's just that rates are higher than they should be. And that's why he keeps calling this a recalibration. And so without sort of an emergency driving factor, the views are all over the place, and we try to figure out is Powell driving the consensus? Is he strong enough to pull consensus? Is anyone in the middle with him? I think he has plenty of supporters in the sense that we could do 25 or 50. You know, the data will tell us what we need to do.
Do you buy into the narrative that businesses are holding back on hiring or firing because of the policy uncertainty surrounding the election and what next year brings?
I mean, certainly election uncertainty does create paralysis in decision making. We can see that there's no churn in the economy. There's not a lot of churn in the housing market, not a lot of churn in the labor market. People aren't feeling confident to leave their jobs and look for something else. People, when they're separated from jobs, are having it's taking longer to find another job. And yeah, companies have been sitting on pretty, sustainable level of payrolls. They don't really need to ramp up hiring. They aren't cutting. And so it's just sort of a stasis. And certainly policy uncertainty probably has something to do with that. But I also think that, we sort of reached a point where payrolls are kind of lean and exactly what companies need. And there's not any particular deceleration or acceleration in the economy to drive a change.
If that's the case, and the unemployment rate maintains at 4.2%, could we see a Fed that doesn't cut in November?
No. I'm gonna say, look, I don't put a 0% probability on anything. That's burned me in the past. So let's say a 5% probability that they actually don't cut in November. I mean, we have so few data points before that meeting, and I think given that, using Powell's own word, given that there's ample room to cut right? You have room to continue to draw rates down, and especially because inflation remains muted.
Just a bit of bow on it. Can I ignore inflation data next week?
Yeah. I'm going to say yes.
That's a new world.
I'm going to say yes.
Why is that?
I'm going to say yes because let's say that it surprises to the upside. Well, then that's the first upside surprise in a string of really solid disinflation numbers. And so it's just one print.
I'll ask another question to put a bow on it. Can we remain in this stasis, this lack of churn, for a very long time?
Probably not. I mean, this is something that you said at the beginning of the segment, right? That typically when you're sort of in this kind of neither here nor there area, it's going to break up or down, and it's likely to break down, not up. Given all of the global risks you all spoke about, given the election uncertainty that you brought up, I mean, it's hard to point to upside risk to the economy here.
Ellen, appreciate your time. Wonderful work this week.
Yep.
Don't take our job. Ellen Zender of Morgan Stanley Wealth Management. Ellen, thank you so much. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. President Biden's latest effort to lower student debt has hit another setback in a federal court. The ruling from a judge in Missouri argues that the plan is an unconstitutional overreach of executive power. A coalition of 7 Republican-led states sued to block the rule from taking effect last month, and Biden's plan would have canceled up to $20,000 in debt for about 30 million borrowers. Rivian shares falling pre-market after the EV maker cut its full-year production guidance. The company saying that it's going through a production disruption due to a supply shortage that's become more acute in recent weeks. Rivian is revising down its estimates for vehicle productions by around 10,000 units, now calling for under 50,000 new vehicles to be made. And Spirit Airlines sinking in the pre-market amid efforts to avoid bankruptcy. According to people familiar with the matter, the struggling air carrier is seeking new financing from creditors and in exchange to extend its current debt. The months-long negotiations have not yet led to an agreement, and if the airline is unable to reach a deal, it may be forced into bankruptcy. The company has until October 21st to find a solution to its financing woes in order to maintain a key partnership with U.S. Bank. And that's your Bloomberg Brief, John.
Shonali, thank you. More from Shonali in 30 minutes' time. Up next on the program, choppy waters in the workforce.
If things are so strong, why is the unemployment rate up? One thing that's not really revised is the unemployment rate. I would just point out that the unemployment rate has been rising despite this seemingly strong economy.
That conversation just around the corner, live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
payrolls 42 minutes away. Equities right now up around 0.25% on the S&P 500. Under surveillance this morning, choppy waters in the workforce.
If things are so strong, why is the unemployment rate up? One thing that's not really revised is the unemployment rate. I would just point out that the unemployment rate has been rising despite this seemingly strong economy. Growth may not be strong enough to keep the unemployment rate from rising. If that's the case, that means that the labor markets are exerting downward pressure on the wages of those that are already working.
So here's the latest, here's the state of play. September payrolls due in just over half an hour. Markets on edge for the next side about the state of the labour market after this week's ADP and jobless claims. Data signalled stability. Becky Frankowitz of Manpower Group writing, going into today's report, our data signals that we're in a labour market that is treading water. We're staying afloat with steady demand when you look at the top line figures. However, there is an underlying weakness that is leaving some employers and workers feeling stuck. Becky joins us now for more. Becky, let's talk about that churn and what might be behind it. And welcome back to the program. Some people have pointed to election anxiety just holding some employers back. What do you think it is?
Yeah, I think there's a host of uncertainties surrounding the labor market. I listened to Ellen on the last piece around inflation. I would say consumers definitely are looking at the inflation numbers. You know, they're shopping with their wallets that feel lighter every time they go to the store or to the gas station. And so while the rest of us may not be watching those numbers, consumers will definitely be watching that and feeling that next week. And so I think election uncertainty is part of it. But really, we're just seeing this treading water labor market, as I mentioned. You know, we're not going forward because employers are concerned about, is the economy really going to turn in a positive direction? Workers are staying put. They're a little stuck. So the great staycation is back again. But more importantly, John, is the undercurrents that I want to talk about that we're seeing. They're indicating some weakness in the labor market. Top of that list for me is blue-collar workers. Blue-collar demand, so we look at real-time job demand, not BLS, which is a look in the rearview mirror. But real-time demand for blue-collar workers is down 3.1% month over month and 4% year to date. And when you dig into those numbers a little bit deeper, you'll find it's frontline manufacturing supervisors that are down 19%. Why is that? It goes back to your question, because employers are really watching where they're spending their money and taking note, do I need production or do I need production supervisors, and making those trade-offs. That's a big area of weakness that we're watching. The other area is hyper concentration of demand. So we have overlying steady, you dig in, blue collars down, then we have this hyper concentration, and a whole new breakout in the September numbers that we're looking at is around science and R&D. Like, we're digging deep to find growth in the labor market, and driving that growth are statisticians, which are up 400% month over month. And you look at who's hiring statisticians, Amazon, trying to get a hold before holiday hiring on what consumers are looking to spend on. So a couple of areas to watch as the numbers come out today.
And Becky, I think that's a brilliant picture, a real deep dive on where we are in the labor market right now. Reveals a bigger question than we've been asking all week. Where are the layoffs? Where are the layoffs? Why aren't they happening?
Yeah, we're still seeing companies hold on. I mean, it's like it's the staycation again on both sides. They're holding on to their talent, not doing layoffs, hiring at a steady rate, John, but not at an astronomical rate. Again, we're digging deep to find month over month growth. When you're looking at statisticians and physical therapists, we're not seeing the big pieces of the economy grow. And so they're not laying off workers. They're holding on to their talent. The internal mobility, as I talk to CEOs across the country, big buzzword. What does that mean? Instead of letting someone go, I move them to another job and work to keep them. It was so difficult to find talent at one point. So we are seeing layoffs. You know, they're not depressed, they're just steady. And in this economy, you would expect them to be higher, but the emotion of the labor force, we talk a lot about the data, the emotion, the feelings, there is still fear, even on the employer side, and they're holding on to their workers.
Becky, you said something that I want to pick up on, that statisticians were the ones being hired. And I think of that kind of staff being used for different kinds of artificial intelligence and automation and different kinds of computer programming that a lot of people say have been driving efficiencies. Based on the data that you're seeing, are those efficiencies coming at the behest of job growth, or is it actually generating a new form of job growth that is just going to take time to show up?
Yeah, well, we know the data would show it's not having a negative impact on jobs today, and candidly, it's not having a positive impact yet. When I say statisticians are up 400%, that's 37,000 jobs that were posted. In the grand scheme of the economy, that's still, it's a big number given it's growing, but it's a small number. And Lisa, for the first time in 9 months, 9 consecutive months of growth in AI and machine learning occupations, we saw a decline. And yet we saw this rise in statisticians and mathematicians. Why is that? It's because companies are taking a step back and saying, okay, AI is coming for sure. There's a lot of hype around it. What do I need to do now versus getting ahead of myself with AI? I need to get foundational data. I need data that I can organize and aggregate and pull from in a way that helps me make informed decisions. And I believe that's actually a very foundational move for the labor market and a good one for the future. We're going to see AI grow again, make no mistake. But the first step is making sure your data is stable. But even before AI, you can do a lot of analysis on data, which is what we're seeing hirers like Amazon, Walmart start to do.
Becky, we're at the start of the year where holiday hiring kicks off. How is it looking right now?
Yeah, so slower start to the season, Anne-Marie. If I was on this time last year, I would have been telling you we're ready for an early start to hiring. We're seeing that demand pick up. We're not seeing that demand pick up yet. I know the estimates out are about 520,000 holiday jobs. That's lower than we saw last year. But I think even within that, what we're seeing that's interesting is it's going to be another brick and click holiday season. Brick, we're seeing increase in demand for retail salespeople, retail supervisors. On the click side, again, statisticians. So last year, I would have told you logistics. We'll see logistics pick up. Things have to get from point A to B, but the statistician piece is new. But I think even more interesting than all of that is the approach that employers are taking to hiring. So we have UPS, Macy's, Target, these kind of companies prioritizing the candidate experience. Like, how do I actually hire someone? For UPS, you can apply and get a job offer within 10 minutes, an offer, not an interview, an offer. For Macy's, it takes 5 minutes to apply, and they've committed to an offer within 48 hours. So we're actually seeing this war for talent show up on speed and reflecting the candidate, which is another reason, John, why we're not seeing layoffs. And it's because employers are still feeling like employees have a lot of power in today's labor market.
As you were talking, Lisa was thinking about applying. I could see the wheels churning.
For what? A UPS driver?
Macy's, UPS, see how quickly it works.
Are you trying to get, actually,
no,
it's totally true as an
how fast it works.
I know exactly.
I
want to see like the response time. Stop knowing me.
I read your mind.
It's really annoying.
Becky, thank you. Becky Frankiewicz of Manpower Group. Some real depth on where we are in this labor market.
I thought that was a fascinating conversation, this idea of a step back, a lot of technological changes happening very quickly. How do we assess how to do it in the smartest way? And that's the paralysis maybe before potentially a breakout in a positive way, but how long it's going to take before we get there.
Big hour coming up next on this program. Nadia Lovell of UPS, National Economic Council Director Lel Brainerd, Mohammed Al-Aaron of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. The third hour of Bloomberg Surveillance up next. The Jobs Report, 8:30 Eastern Time.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Fed's laser focused on the labor market.
If the jobs data does diminish, I think they have to go ahead with the 50 basis point cut.
I think it'll be a decent payroll employment report.
We're going to have a pretty messy payrolls.
This jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
8:30 Eastern Time. It's 30 minutes away. The jobs report just around the corner. The scores going into it look like this. Up 0.25% on the S&P 500. On the Nasdaq right now, up by 0.4% through Thursday, heading towards the biggest weekly loss on the S&P going back a month. In the bond market, yields have been creeping higher over the last 3 days, largely off the back of the move in crude. Less of the commodity market, much more about the labor market for the next 60 minutes or so. The estimate in our survey, 150K, looking for unemployment to stay at 4.2%, but as Lisa has said repeatedly over the last month, for many people on Wall Street, there should be an extra line in there now. It should be about revisions in America because a lot of people are putting much weight on that than they are on this.
Because ultimately it makes a big difference if you see 165K, which is at the north side of the estimates by Goldman Sachs, and you strip off 60,000, suddenly you get to where the low calls are for, say, 70,000 from what we hear over at Citigroup. The question for me is whether we're going to see revisions, whether that's going to move markets, or whether it's going to be the unemployment rate, because we heard that from Ellen Zentner, and then we heard Neil Dutta, unemployment rate, why is it going up, unemployment rate. So how much does it make a difference if it's 4.22% or if it's 4.26% and gets rounded up to 4.3?
It's a hard payrolls report because of the estimates. 220 is what Jeffries has, and then 70,000 on Citi. It's an ocean. And when you look at some of these estimates in terms of how far apart they are, pre-Misra though, the question remains, we are normalizing or going below trend. And that really is some of the details I want to see from this report.
Got CPI data next week. Ellen Zentner of Morgan Stanley on the program 15 minutes ago saying, don't even look at it. Basically, not precisely her words, but essentially that was the message. That was the essence of the argument. Don't even bother. It's all about the jobs report now.
It was the same essence that she made that also we heard from Priya Misra, which is the inflation threat, in her view, is dead. The idea of oil and somehow the tick up that we've seen being an inflationary threat is anachronistic because ultimately that will be a tax on people that will slow growth. So that's basically the argument that people are making. That said, I do wonder, listening to what Becky Frankowitz is saying, if companies are just sort of in stasis, girding for a number of uncertainties, whether it's what's going on in November, or also some of the technological changes, that's a very different picture.
You mentioned crude, 4-day rally. on crude, the biggest weekly gain of the year so far after the biggest one-day pop we've seen so far in 2024. Brent crude right now up another 1.3%, just short of 80. WTI getting closer to 75, up by 1.4.
The latest surge coming from the spike in oil prices from the words of the President of the United States. Asked directly, would you support an Israeli attack on Iranian oil facilities? We're discussing that. Crude immediately takes off. But the issue is now, is the president being very transparent, or potentially is he a liability in these negotiations because he's being so transparent? And then is he moving oil markets because he's basically saying, yeah, there's potential there's going to be more disruption in the oil market out of the Middle East?
Well, if you're running for election and you're worried about higher crude prices, liability. Ultimately, 78.63 on Brent crude, and a lot of that is down to some comments from the President of the United States yesterday afternoon. Big hour coming up on this program. Coming up, Nadia Lovell of UBS as investors await September payrolls. We'll catch up with the National Economic Council Director, Lael Brainerd, as US dock workers agree to end a 3-day strike, and Mohammed Al-Erin of Queen's College, Cambridge, on the Fed's 50 basis point insurance policy. We begin this hour with stocks on hold ahead of the Fed's next big data point, September payrolls, and in just under 30 minutes' time. Nadia Lovell of UBS saying this: the macro backdrop and fundamentals are favorable for equities. The economy is growing at a healthy clip, and the Fed is easing monetary policy. We look for an additional 50 basis points of cuts this year, with the potential for more if the labour market weakens. Nadia's with us around the table. Nadia, good morning.
Good morning.
It's good to see you. Let's talk about what you're expecting in 26 minutes and whether good news is truly still good news.
Yeah, we think so. I mean, we think that the market will, react positively if we get, 150 to 200K and the unemployment rate remains stable or even tick down. We know that everyone is watching the unemployment rate. That's what Powell is focused on. And so if that ticks up, it puts 50 basis points on the table for November, but we're not quite there yet.
The data this week has been really hard to read. Lisa mentioned the ISM services number we got in the last 24 hours. Headline number, great. New orders, brilliant. Employment component, concerning. Had job openings earlier this week. Job openings higher, decent, but then you saw hiring slow. Then you started to see the quits rate come down as well. Slightly concerning. What are you telling investors, your clients, to do with the incoming information right now? Should they put more weight on one versus the other?
I think when you look at the data as a whole, it does still point to an economy that's still growing. You look at where GDP now is tracking. We know that some of the employment data has been noisy, but you also need to listen to what companies have been saying. Is monetary policy restrictive? Yes, we saw that in the survey comments in ISM, but it feels like the growth is still there. When you look at some of the revisions that's happened, and I'm talking more specifically on the savings rate, Lisa, that the savings rate is actually higher than previously thought. So the consumer has more of a cushion than people had thought, and consumption has been driven more by income growth. So when we look at all that together, that still paints a pretty favorable picture for the economy and for equities.
That said, as John mentioned, there was this increase, a further increase to a new record in money market funds, because there clearly is a whole bunch of uncertainty right now. Still, however, valuations are very high. It's not as if a lot of that heat has been taken out of the market. How much do you push back against the argument that it is difficult to get bullish from here just based on valuations, considering all the potential risks that we have coming forward?
It is definitely something that we're cautious on. Reality is we do think that near terms that the market could get choppy. We're heading into the elections. We also have geopolitical risks. And then we're in October where there could be potentially incremental information around export bans on U.S. semiconductor chips. So we have been advising our clients to really prepare for a pickup in volatility and using some hedging strategies to help mitigate some of that. But that said, even though valuations are elevated, a lot of these companies are growing into that valuation multiple. When you look out in the next year, we still think that you can get high singles to double-digit earnings growth, and that will help in terms of companies growing into that multiple. Ultimately, we think that with the positive economic backdrop, that this is a market that could get to 6,200 by the time we get to next year. So choppy near term, but into year-end and into 2025, we continue to encourage clients to use pullbacks to add to the market.
How much does that 6,200 prediction hinge on the idea of a pretty accommodative Fed, one that is much more predisposed to cutting by 50 basis point increments rather than 25?
I think that's a great question, Lisa. I mean, our core view is for 50 additional this year and then 100 basis points next year, sort of a quarterly cadence. Of course, if the data breaks down, we do expect that to be accelerated. But when you look at the data so far, I mean, as Powell has noted, it doesn't feel like monetary policy needs to be acting at a fast pace. We expect it to be more gradual. And so we're not factoring in the sort of rate cuts that the market is now pricing in. And we think that equity markets can absorb that 100 basis points next year and sort of a trend back towards neutral rate.
Nadia, you said you're watching the election. You currently give a slight edge to Kamala Harris. Does that mean for the market, the risk is going to be corporate earnings rather than inflation because of tariffs?
So when we think about the election, we assume that Harris, 55% probability that she wins, but most likely with a divided Congress. I think the thing that we're very most closely concerned about is a Democratic sweep, because that has implications for corporate taxes. Could it go to 28%? If it does go to 28%, that's a mid-single-digit drag on S&P earnings, and it's probably the same sort of reaction from a market pullback standpoint. You remember when Trump, lowered corporate tax rate, several years ago, we did see the market rally 10%, but that rally did not happen until we got more details on that. So we do think that that needs to be watched, and also even in a Trump victory, tariffs could be quite disruptive to markets.
And that's unilateral. When it comes back to a potential Democratic sweep, and you think that could be worse for the markets because of the changes to the tax policy, how much drawdown could we see, say, like on the S&P 500?
I think you can see a knee-jerk reaction in the days after. Hopefully it's just days after Election Day that we know the results. You could see a knee-jerk reaction, a couple percentage points. But again, the market is going to wait for some details, because we know promises are made. They don't always translate into policy, and the devil is in the details. And last time the Democrats were here, Sinema pushed back. Now, Sinema won't be an issue this time, but another Sinema type could arise, and push back on the raise to corporate tax rate.
How much are you watching, just sort of in the panoply of potential risk factors, how much are you watching what's going on with oil prices as a potential catalyst for you? How do you play that at a time where it's considered a growth dampener should it persist?
Absolutely, and that's the word, persistence. We do know that historically, like a $10 move in oil prices sustained over a 3-month period could be, 40 basis points, 50 basis points of headline inflation, but in reality, in core inflation, it's a couple of basis points. So not overly concerned about our oil view near term. We did take a little bit off the table in oil after Biden's comments and the spike that we've seen in oil prices. We are still slightly positive on oil, but reality is we think that there's going to be this remaining concern about supply, excess capacity. We know that, the OPEC, 5 to 6 billion barrels a day of excess capacity that's potentially in the system, and then Libya as well this week. So the oil market hasn't really tightened this week. What we're seeing is a geopolitical risk, and so we think that oil can get above